Good morning and welcome to our 12th annual educational event for landlords. I am Chris German from The Apartment Dealer, and over the next 90 minutes or so, myself and the panel of speakers that we've assembled for you are going to address the most pressing issues when it comes to owning investment real estate, and more specifically, the ownership and management of multifamily properties. Now, I call this an educational event because under normal circumstances, this normally would be a live, in-person, luncheon style setting. But as with many aspects of our lives, given COVID, we've had to pivot and change the format. But again, we felt it pressing enough with all that's gone in the market the last 14 months to present this information to you. I also want to share my thoughts with the landlords, our clients, who have had challenges in their health, personal lives, in their business lives, and in this setting with respect to the ownership of their properties. I hope you and your family are faring well at this time. And these are interesting times. We're at a point where in about a month or so, we hope that the eviction moratorium will be lifted, which is good news. But we have to take pause that there was a moratorium on evictions to begin with, that the politicians overreached as far as they did. Over the last 14 months, there's also been more than $4 trillion worth of stimulus printed and pumped into the economy. And while the economy is feeling a high of that money right now, what does it mean to the market long term? And second, politicians are currently debating, do they double capital gains tax? Do they do away with the step-up basis to help foot the bill of all the stimulus that has been printed? In our time together, the goal here is to get straight answers to these tough issues, give you food for thought as you contemplate your next real estate transaction, and to ensure you have the right information for the road ahead. To get those straight answers, I have 5 of the most prominent figures from the other areas of real estate law, taxation, lending, and market forecasting, who amongst them have decades of experience, not only in their fields of expertise, but are also landlords themselves. All of us own multifamily property. We have skin in the game. So the answers that you'll receive today, the information you'll receive, the insight, is not just textbook answers. This is what's applicable for today, what's working today, what landlords are doing today. With us today, first I have Mr. Stephen Hall. Steve is an enrolled agent, senior tax consultant, and belongs to the National Association of Enrolled Agents, California Society of Enrolled Agents, National Society of Accountants, and is the former chairman of the Large Tax Practice Group. Steve has been with us a number of years, and he brings the insight from working with individuals of very high net worth. And if the saying is true that the rich only get richer, we don't want to say why, we want to ask how, and Steve's here to share those insights with us. So Steve, thank you for being with us today. Next, we have with us Mr. Steven Spear. Steve is one of the 2 founding partners of the law firm Spear, Woodward, Corbelis, Goldberg, which began operating in 1978. Steve and his firm focus on litigation and transactions in real estate, business, and estate planning. Steve has been awarded the highest rating by the national rating organization, Martindale-Humble, AV, meaning preeminent, high legal ability, very high ethical standards. Steve hosts a live Saturday radio talk show broadcasting live from talkradio1.com and has ownership in apartment complexes, shopping centers, office, and commercial buildings in California, Arizona, Washington, and Colorado. Steve, again, is one of those individuals that's been with us now over a decade, and he brings the insight of representing landlords like you, litigating cases in some of those more controversial issues. So, Steve, thank you for being with us. We have also with us Mr. Bruce Norris. Now, Bruce, for over the last 35 years, has been an investor, hard money lender, and real estate educator. Bruce has impressively been involved in more than 2,000 real estate transactions as either the buyer, seller, builder, or money partner. Bruce has an is just an innate ability to identify inflection points in the market dating back to the mid-1990s in through the 2000s, where he was able to share with those that followed his work at the time points in the market where prices were going to increase or decline, and in either case made or saved investors a lot of money. Bruce also invests outside of California, brings that insight with him. And so, Bruce, we thank you for being with us here today.
Thank you, Chris.
We have Mr. Gil Figueroa. Now, Gil, for nearly 3 decades now, has been involved in lending, commercial lending, and more than just a loan officer. Gil has that knowledge to identify or look at and analyze the other markets at large, the stock market, bond market. What does it mean to interest rates? What does it mean to investors? What does it mean when it comes to your ability to leverage? And for about the last 3 years now, for those who have attended our live events, Gil has been able to identify whether rates were trending upwards or downwards, and again, saved investors a lot of money. So Gil, it is a pleasure to have you with us. And last but not least, we have Mr. Mike Brennan. Now, Mike is a household name here locally when it comes to tenant evictions. With over a decade experience in his focus of tenant evictions, you must have seen Mike either at a trade show, speaking for the various boards. He's been on our show specifically over the last year since the stay-at-home order was announced. Mike was nice enough to break apart the legislation as it was being announced, and if you remember what last year was like, about every other week there was something new. Mike stepped in, broke it apart for us, kept landlords in the know. And so, Mike, thank you for being with us here today.
Thank you.
The information that we looked to cover was in vast part submitted by you, the viewers, questions you submitted at the time of registration. And so we're going to be going through those this afternoon. And so we're going to start with this question here. And I'd like everyone to give us your thoughts. How will COVID shaped multifamily investments and the real estate market going forward? Mr. Spear, why don't you start us off?
I think that things are actually going to be just fine. I think a lot of people are very worried with the government overreach. There's lots of reason to be concerned with regulation, with rent control, with the moratoriums, with whatever else they might come up with next. But overall, nothing is going to change the supply and demand that people who live in a place need to have a place to put their head on a pillow. And the constant rolling average of home ownership is not really going to get much greater. There have been all sorts of government schemes made to try to increase it. They've all had disastrous results. So you're going to have a tremendous population that lives in apartments. And you can't have a local job and sleep on the internet or sleep in China. You're going to sleep fairly close to where you live. And I don't think that's going to change. And since supply and demand is to economics and money what the law of gravity is to physics, I don't think any of that's going to change. So COVID will leave some improvements and will leave some detriments. One of the detriments is going to be a long backlog on evictions. The court system right now is smashed and broken. It's going to take a while for it to get caught up. There will be all sorts of political moves made, but in reality, if you have a serious housing shortage, which is what we have, the only solution is to create an environment in which developers will want to build more apartments and in which owners will want to keep apartments online and keep them maintained properly. I think on balance, all of that is going to be just fine. The remnants, the specific remnants of COVID and what it will do to the apartment market, I think are going to be fairly small. I think that the future is bright for apartments. We have no plans to sell any of the apartments that we own, operate, and manage. We are in an acquisition mode and will continue to look for proper apartment purchases to make going forward without hesitation.
Gil, your thoughts on the lasting effects on the market from COVID?
Well, the lenders are finally coming back, and they're still looking at receipts in the last 12-month history, more so than they ever been before. So the lenders are very much in touch with the historical of the property and your tenant's performance. So unlike any other time in history, having a relationship or a communication with your tenant is super important.
Mr. Brennan, your thoughts?
Well, I agree with a lot of what Steve said. I have slight disagreements with some of what he said. For example, I believe that what came out of COVID was that people started working virtually. And I think that people will continue to do that. A lot of people will continue to do that. I recently read a book called The Fourth Industrial Revolution that highlights that, talks about the speed of the change we're facing right now. And it appears that will linger with us. More importantly, though, what I think will linger with us is the legislation that came out of COVID. So, for example, the COVID protections produced, instead of a 3-day pay or quit, we got a 15-day pay or quit. And what I'm starting to see on the legislative side of things is that some of those protections are being introduced as separate bills down the line to keep those protections in place. So, for example, I would not be surprised at all if in the next legislative session we see a bill produced that says, hey, instead of 3-day notices, we're going to stick with the 15-day notices. So I think that's my biggest concern is the lingering components of the legislation that came out of COVID.
I want to chime in here for a second, and then I'm going to pass it to you, Mr. Norris. So Mike mentioned the issue of working from home. And so if I were to say the lasting effects on the market that we're starting to see right now is people, I would say rethink. Rethink your tenant demographic. Because with COVID, we got this new term called essential worker. So if your tenants were essential workers, it was more likely that your rent showed up. And if they were not essential workers, you were more likely to miss a rent payment. And so in terms of looking for a certain tenant demographic, we then have to rethink the location of some of our properties. Are our properties of the quality and location that would be attractive to these individuals that are either moving out of the cities into the suburbs? That's why you've seen a big explosion in the Inland Empire and Riverside County in terms of values and rental rates. And the unit mix. We've seen people trading studios and 1-bedrooms for 2 bedrooms and 3 bedrooms because working from home, now they've opted to have, say, an in-home office, or you just need more space overall because you spend so much more time in your rental unit. So these are the things that I would say are going to shape the market. Investors rethinking the tenant base, the demographic of that of which they own. Bruce, what say you?
I think most of us were completely surprised by the public's reaction to the coronavirus. 2019 showed a decline in the price increases despite the best set of charts ever for that to occur, and that didn't occur. And so about March of 2020, when the coronavirus hit, there was a lot of uncertainty what was going to happen. Well, what happened was 2 urgent groups did their thing. 50% of the listings disappeared from the MLS. You're not touring my house, so I'm not going to get sick. What happened on the demand side, though, was extraordinary. A whole group of people said, I've got to buy. First-time buyers at numbers that we haven't seen in many years, and move-up buyers and relocation buyers. So all of a sudden you had 125% of demand land on 50% of the inventory, and you guys know what happened. Prices have taken off. You now have days on market less than 10. If you have something for sale, you're going to get not only multiple offers, you're probably going to get much more than you ever dreamed of and more than the appraiser can appraise it for. And it's interesting, the chart, one of the charts that we follow has inverted only for the first time in history, 1980, 89, 05, and in December of 2020, an existing house has surpassed the cost of a new one. And what's interesting about that is when you own real estate, ultimately you own a basket of commodities. And so when lumber goes up for new houses and concrete goes up, it goes up for what you own too. So isn't that pretty cool? I think so.
Mr. Hall, your thoughts, COVID and how it shapes the real estate market going forward?
Thank you, Chris. I agree with everyone's comments today, especially Bruce's about the inflationary pricing of materials, et cetera. I think long-term, we're going to feel the effects of what's happening from a inflationary effect overall. And with COVID specifically, whenever government intervenes with the private sector, it always creates a hangover effect. And what I mean by that is we're going to pay the price for these moratoriums. We, meaning the population, will, whether it's in the increase of artificial decrease in supply, which means it has an artificial increase in demand, which then could level out pricing down the road. I think we're in for a unforeseen crisis down the road. What I mean by unforeseen is I can't predict when it's going to happen or how it's going to happen, because the government keeps on intervening with the natural process of trying to make the landing soft. But what I think is happening though is with some of the mechanisms they're using to create a soft landing is actually going to create a harder landing down the road. And I have no idea what's going to shake out. It's hard to predict anything now because there's just been so much manipulation with the financial system as well as the governmental interventions, for example, with evictions and interventions with unemployment. One thing we didn't talk about earlier is COVID has created the CARES Act, which created unemployment subsidies for many folks that are living off of unemployment. And what does that mean is for employers cannot find qualified labor right now because the folks that they want to hire are living off of unemployment wages. And those unemployment stipends, not wages, but stipends are changing the job pool as far as who they can hire from. But the big question is what's going to happen to the marketplace when the unemployment runs out and when the employers have already solved their problems of finding those jobs with alternative methodologies. For example, vacating California for a place to hire folks and using other mechanisms to hire people, whether it's out of state or out of country. And I see more and more clients utilizing those structures where they're outsourcing some departments of their companies, not because they want to, but because they can't find any folks to do the work. So I think we're going to see some long-term effects of those policies.
Let me make a comment just on the general economy. When you look back to 1964, Lyndon Johnson trounced Barry Goldwater in the presidential election, winning, I think, all but 7 states. He had a Democratic legislature, both houses of Congress, and was himself a Democratic president. He passed some great legislation, the Civil Rights Act of 64 and 65, and then he went on the move for the Great Society and for the war on poverty. And what he did when he did that is he spent unprecedented amounts of money. He wanted to finish what he saw as the job of Franklin Roosevelt. I think that's some of what we're seeing now with the tremendous spending. The consequence of that is economic, it is a surety, there is no doubt about it. It is exactly what then happened in the late 60s and through the 70s, where you had tremendous stagnation and inflation, which they named stagflation, and enormous opportunities for people who own equities, whether it's businesses or real estate, in particular real estate. You had people buying real estate and selling it months later for double the price. It was staggering. It's something that will be inevitable here. It's something to bear in mind. If you own real estate, you probably want to own more of it. And if you don't own real estate, you probably want to buy some.
So to that, one of the landlords asks, what can we do to protect our real estate investments in the current climate? Mr. Brennan, what can we do to protect our real estate investments in the current climate?
Well, I think right off the bat, given the changes in the legislation that have taken place over the past decade and what I anticipate taking place over the next decade, I would start with my leases and my lease-up documents, and I would go through them thoroughly. I would do everything I could to get the most current, up-to-date lease and leasing documents. I would review my tenant screening policies. I would also dig in a little bit deeper in the sense that I would start maybe following, I don't want to say politics, but maybe the legislation, the proposed legislation, as much as you can as a landlord. and continue revisiting all of your documents and your screening policies. I agree with everything that's been said here so far. I think we are coming upon, for lack of a better word right now, shaky times, and employment trends are shifting, housing trends are shifting, and these are the reason I say this is these are the reasons given for some of the legislation that's coming out. There's a lot of shifts going on, and I think as a landlord, the best thing you could do right now is stay on top of the shifts, stay ahead of the curve, and do that through your documents.
Gil, from a lender's perspective or from the loan side of things, what can landlords do to protect themselves?
I think one thing I see with landlords is their diversification is a little weak. I think there has to be more liquidity as far as be able to handle any shortfalls. That's the main thing I force my clients to look at is, how many months of liquidity can they support their portfolio. That being said, I think it's a great time for landlords to look at what you mentioned, Chris, as far as being close to the necessary employment, hospitals, et cetera. I think these are going to be hot points where the market is really going to heat up.
Now, Bruce, I called you maybe halfway through the pandemic asking for your advice on this liquidity issue. And I shared with you, here's how much debt I have on my properties, here's what I have liquid, and we discussed, what was advisable. What are your thoughts here? How do investors protect themselves during these times?
There's two sets, and maybe it has to do with age. So I've really struggled with this because it's the cheapest time in history to borrow money, and I haven't borrowed a dime of it. But it's because I'm 68, and I like to wake up every morning and be bored. But that's a different story when somebody's your age. That's a different thing. And if you're going to have inflation, if prices are going to go up, and leverage, then possibly is a very wise thing because you're borrowing at a fixed cost at a historically low rate, and your assets have a good chance to still escalate. So I don't think there's one answer, to be honest with you. And you have to match it to your comfort level. And not just your comfort level, by the way. You ought to ask your wife once in a while, how do you feel about this? Because that's a true statement. When we sold a bunch of properties because we saw the crash coming in 2005 and 6, I actually talked to my wife. I said, to avoid taxes, I will have to exchange all this to another state. And she said, couldn't we just pay the tax and relax? And you know what? We had taken a 20-year journey to get to the point where we never had to worry about money again, and I agreed and paid off everything, and it's still the best thing I've ever done. I only don't like it one day a year.
And that day, going to Mr. Steve Hall, right, the accountant in the room. But what say you, Steve? How do investors, real estate owners, protect themselves in the current climate?
Like Bruce said, you got to be smart, as far as your leverage ratio, and what Gil said earlier was important. Make sure you have at least 6 to 12 months worth of cash on hand to handle any shocks in the system. But from a tax perspective, I'm sure Steve Spurrier will chime in on this. The Biden administration is talking about lowering the estate tax ceiling. So it's important to make sure you have your living trust and your estate plan in place. Because just because the government has high estate tax ceiling rates today at 10 million doesn't mean it'll be there tomorrow. So it's important to plan annually to see what you can do to start shifting some assets to your heirs, or to at least prepare for a lower estate exemption ceiling, et cetera.
One of the most important benefits, one of the many, but one of the most important benefits to owning real estate are the tax advantages. So absolutely, Steve Hall is right. If you own real estate and if you plan your estate properly for succession planning, you can do tremendous tax savings. And 1031 exchanges are still here. There are lots of things that are still here. Capital gains at lower rates are still here. And these are things to take advantage of while they're still here.
One of the comments I would make to protecting your investments, because when I think investments, I think cash flow. And so it would be to ask yourself the question, is your unit a tiebreaker? And I actually got that term from Bruce, and Bruce was talking about a property, in whole, but I'm thinking about in terms of the rental units. And here's why. So my wife and I purchased an apartment building in March of last year. Just as the stay-at-home order was being announced, I'm closing escrow, so you can imagine that was a lot of fun. But we had plans to renovate the entire property, all the units, do substantial improvements, reposition tenants, which we did. It took a year, much longer than I anticipated, but given COVID, there were some delays. What was the net result? The net result was that our rental rates are now about 13% higher than the, say, ceiling market rate in the city of which we're in. Again, we did this during COVID. I was leasing the units during COVID, and we didn't offer any tenant concessions. And the tenant base, the tenant demographic, and we've done a lot of work on this if you've watched any of our educational videos, but the tenant demographic that we drew to the property, given the condition and what we had done, are those that are going to pay us in the long haul. So that would be my thoughts on protecting the cash flow itself. Mike, you had a thought here?
Yeah, I was going to add something that I left out, and it kind of ties into your next question as well. I want your clients to know that I'm starting to see a significant increase in affirmative actions against landlords, civil lawsuits. So one thing that dawned on me as everybody was talking here that I didn't mention was I would certainly sit down with my insurance carrier, revisit my portfolio as often as I can, and make sure that I'm carrying not only adequate coverage, but coverage for the claims that you may not anticipate coming, such as habitability claims, but more so right now, I'm seeing a lot of fair housing claims. So not everybody's insured for that. It might not be a bad time to talk to your carrier and see where you're at and see if you have adequate coverage.
That's excellent advice. And the other advice that goes right along with that, and I know Mike as an attorney would agree with me as an attorney on this, this is the time to redouble your efforts to be a proper landlord. Do the right thing. Maintain the property. Don't give unnecessary opportunity for some lawyer to bring a claim against you for a habitability defect. Don't do things which are going to get you in trouble with the Department of Fair Housing. Don't do things that are simply wrong, things you know are wrong. Do things properly, manage properly. Insist that your property managers manage properly and provide a clean, safe, proper space for tenants. They are the customers. If you treat it that way, you not only will get sued less, you'll make a great deal more money.
So that ties right into the next question, which the landlords asked, what's the best way to limit liability with your tenants, whether that be the legal entity and tenant policy? So Spiro, I'll let you tackle this one really quick because we get asked this at almost every event 12 years later. Do you own it in your trust? Do you own it in an LLC? Do you own it in a corp? Does one own the other? Let's start there, and then maybe the rest of us will, since we're all landlords, talk about our own policies and what we do to limit liability.
So what you need is an estate plan, and your estate plan will own everything you own. It'll own your bank accounts, it'll own your cars, it'll own your house, it'll own your investment properties, it'll own your stocks and bonds. Then, once it owns it, the property itself is going to be owned, if you're renting it out to tenants, it's going to be rented out to, it's going to be owned by a limited liability company, an LLC. The LLC will be owned by the estate plan. So again, the property is owned by the LLC is owned by the estate plan. The estate plan, the trust, the living trust, doesn't create any shield for liability at all, but the LLC does. And think of it like a watertight door on a ship. Anything that happens inside that LLC to that one property, you could lose that property, you could have liability there if you have an uninsured event, back to Mike Brennan's point. You want proper insurance, not just enough coverage, but the right coverage. And that should be through your insurance broker that you sit down and really have conversation with to see if you're getting the right coverage, what all the possibilities are, which ones you want, which are worth paying for, which are not, adjusting your deductibles accordingly. Then when that is owned by that corporation, if something happens inside that corporation or LLC, that limited liability company, it can't contaminate your other properties that are owned by other LLCs. It can't contaminate your stocks and bonds that are not owned inside that LLC. It's going to be something that limits your liability. And what we've seen in court is these things hold up very nicely if they're done well, if they're done properly, properly maintained. And if you segregate funds and truly treat that LLC as having its own money. If you use it as a personal piggy bank and pay personal expenses out of it, a plaintiff's lawyer will go through it like a hot knife through butter and so will the government in any type of an audit.
Mike, any further thoughts in this area?
I don't think I could have said it any better than Stephen said it, and I really don't have anything to add. I do want to underscore what he said, though, is it's got to be done right. So it's not the type of thing that I would say hop on some internet company that's going to create an entity for you. I would say seek out the professionals who do it for a living and know how to do it.
We've made a lot of money in legal fees, most unfortunately, for people who have used internet companies, to Mike's point, to form their companies, didn't do it right, didn't learn what they needed to learn and should have gotten from a lawyer who would have educated them in how to run it properly so you actually get the benefits of it. It's more expensive, but you actually get the benefits.
If I may interject, there's never been a better time to have professional management. Me, myself, real estate's a secondary form of income. And I think a lot of owners have to understand their capacities and be honest to themselves. This is not a time to learn. This is a time to be engaged, have a business plan, have a plan for your tenants, and have professional management if you're not up to par.
Well, and with respect to the management aspect of it, I think, because again, I meet a lot of landlords, say on a monthly basis, and where a lot of them fall into trouble is they get too friendly with the tenants. So it comes down to tenant relations. You want to be friendly, but business-like. You want the tenant to understand what their portion of the contract is and what's yours. And to Steve's comments earlier, that you want to respond to maintenance requests and those type of things in a timely manner, of course. But you have to hold your tenants accountable, because I can't tell you how many landlords that I've met or work with who say don't do things like a 1031 exchange because they're fearful of all things what the tenants will think about them selling the property and moving on. Or they're fearful of what will the next owner do with their beloved tenants. And let's say on average, our clients see an uptick of 15 to 20% in their net income when they go through the 1031 exchange. They're bypassing that because they're so friendly with the tenants. Anyone have a thought on that in terms of the interactions between you and your tenants if you self-manage?
Well, I could underscore everything Chris just said. All I do is landlord-tenant work, and I can't tell you how many times a week I hear almost verbatim what Chris just said. How are we going to do this? Because I've known these tenants for a long time, or we've always had a close relationship. Now they're not paying. And I would say separate it. It's just like any asset. If you're pouring emotion into it, you're probably approaching it incorrectly. Take the emotion out of it, separate yourself from the tenants. I'm not saying don't be humane, but I am saying that you have to understand that your properties are your assets. The relationships that you build, if you do build those relationships with tenants, I hate to sound cynical about it, but when things turn bad with any given tenant, that relationship's out the window anyway, and the tenant is coming at you as a landlord full bore. So I agree 100% with Chris. Separate it, and the other comments made about, this may be the time for a management company. But I will say this, even if you move forward and get a management company and separate yourself from that, I still encourage all owners to continue their education through this type of presentation, through online courses, through reading. Continue your education, because just like any industry, management companies range from very good to very bad. And simply because you hand somebody that has a management company your assets does not mean that they know what they're doing, does not mean that they follow the laws, and does not mean that they will keep you out of trouble. So be intelligent when you're making that separation, I guess is what I'm trying to say.
Case in point, I was talking to a landlord about a month ago, and they were sizing up a building that they own, and their management company had told them, oh yeah, we can give 60-day notices to vacate, no problem. And I said, look, I'm not an attorney, and I can refer you to two really good attorneys. They're going to tell you that's absolutely wrong, given the moratorium and everything else. He said, no, they have their own attorney on staff, and their attorney said we should be fine. And this is a management company. So you as the owner, you can't claim ignorance in some of this stuff. And while, my management company took care of it, because you're going to be the one that's going to be sued in the end. Now, Bruce, I know that you utilize management. You've had a lot of luck with management. So I want to tie in this next question. The next question is, well, how do you kick out bad tenants for behavioral issues and they're not parking in the right spot, or they're just not following the general rules? What's your approach on those things if the tenants aren't behaving?
You know what? I have never had one. Now, isn't that, that's honestly very weird. And it's the selection process. It's the selection process of the management company and me telling them what I want and what I don't want. And also, I think the response, I think I'm probably an aggressive owner in the sense that if something needs to be done, I'm doing it instantly. And I think the tenant just feels like, okay, I can stay here. To answer your first question, before that, I made the mistake. Well, and I was actually paying what I thought I owed. Many years ago, when I was renting, first got married at 17. We were saving money in a little can, $20 at a time, so we could own. And there was a landlord in Orange County when things were going crazy, didn't raise rent on me for 2.5 years. It allowed me to save the money. I remember that. When I owned properties for the first time in rentals in Moreno Valley, for 8 years, I did not raise rents from 2005 to whatever I sold them. Now in Florida, I raise rents. So I paid my dues, but I've never had tenant problems because of careful selection and willingness to have a vacancy until I got the right person.
Mike, what do you think again for the behavioral type stuff? They're drying their clothes on the railing of the stairs. The kids are a nuisance. Specifically right now, how would you deal with these people?
So I want to touch on something Bruce said because I think it's incredibly insightful and I don't want people to glaze over it. If you want to avoid these kind of problems, the best thing in the world you can do right now or at any time is a thorough screening process. It all starts at screening. If you dig in on the screening, you're going to avoid 80 to 90% of your evictions. Now, going back to Chris's question, what do you do right now in these, I'm assuming he meant under the moratoriums. That's a difficult question to answer. It'll really depend on where your property is located. For example, in the city of LA, you can't serve any notices. In the county of LA, you can serve 15-day pay or quit notices, but there are specific prohibitions against terminating, depending on the moratorium, terminating for nuisance behavior. So let's talk a little bit about pre or post-COVID though. How do you deal with situations where you have behavioral issues? And I go back to what I said before, I would estimate 90% of it can be dealt with through a very strong lease provisions that allow you to terminate the tenancy under certain circumstances. I don't want to take all the time right now to get into the details of what's a material breach, versus a trivial breach. But nuisance is defined. There's about 3 or 4 different definitions of nuisance in California. If your lease documents are drafted tightly, it's not that difficult to pull off a nuisance eviction. Essentially, the key will be documenting it very well. And the bigger challenge that everybody has is getting witnesses to court. But that's a discussion for a different day. But if you've got tenants that are really creating a nuisance on the property and you intend to terminate the tenancy based on that behavior, you've got to be able to prove it in court. So again, strong leases help. Cameras help. Even ring systems are very helpful in proving nuisance cases. And complaining neighboring tenants who are willing to come to court and testify about that. Believe it or not, a nuisance case, I used to think they were difficult to prove in court, and as we've refined our system and our notices and what we advise our clients to do, they've actually become pretty easy to prove a nuisance if you know how to do it.
Okay.
I was just going to mention that I bought hundreds of properties where there was a tenant that was all the problems that you talked about. And what usually instigated that was that the rental itself won no tiebreakers. It was a lousy location. It was maintained horribly, and that eliminated the top 80% of tenants. In other words, who would move here? The least desirable tenants would only show up in the neighborhood or the house. You're going to have problems. So taking care of the house and picking the neighborhood and winning tiebreakers solves a lot of problems with property management.
And if you combine what Bruce said with what Mike said, Mike says Be prepared, document it correctly, have an excellent agreement, follow the contract, follow the law, do all the things correctly, take legal advice. Bruce says, prepare by running your property right. Run the property so that people have a pride of ownership in living there, so that they are happy, they consider it their home, they consider you an ally instead of an enemy. When you take what Mike says and what Bruce says, you combine them together, you won't have as many legal problems as the people who simply look at it as combat, or the people who simply look at it as they're my friends. The tenants are your customers. They are potential adversaries, but if you do your job correctly with the highest of care as a landlord, and then have the proper agreements in place so your legal rights are protected in the event that you find the one person who really doesn't appreciate you, you'll rarely have trouble. And when you do, you'll prevail.
Now, Steve, let me ask you, you made a comment earlier that, to own more real estate. And a lot of landlords that we meet assume that, well, more units and more tenants equates to more lawsuits. And I would argue that, well, that's a reflection of the tenant base. It has nothing to do with more real estate. Or said differently, it's a reflection of your management style, not do you own 10 units versus 30. Would you say more real estate means you have to have more headaches?
No, not at all. I think it's exactly the opposite. I think the person who owns a duplex, lives in one unit, has the other one, hasn't had many tenant experiences. They're more likely to make mistakes. They have fewer people to make them on. If you have someone who owns 5 or 10 or 50 or 500 units, that person is going to get better and better at management. They're going to be better if they're using a management company at supervising the management company. They're going to get systems in place. They're going to have the proper agreements. They're going to take the time and the trouble to do it. I think you just get better as you get bigger, as long as you continue to get better as you get bigger.
Now, Gil, both you and I have clients, landlords who own hundreds, even thousands of units. What would you say you've taken away from those that seem to run a tight ship and they still have a life outside of being a landlord?
System. They have great systems in play. They have a game plan. They have professionals that they meet with regularly. They fine-tune their game plan constantly. They're always keeping up with all market conditions as far as interest rates, as far as legalities, tenant legals. It's someone who's focused himself to be 100% in the business.
Now, of course, there's a question here regarding the eviction moratorium and can we evict? So, Mike, I'll start with you. Given the eviction moratorium, which is still in place, what do we do about tenants who claimed COVID in the past, maybe aren't claiming COVID now, but some point here during the last 14 months they've claimed COVID? What do we do now?
What do you do about the unpaid rent for COVID?
Yes.
All right, so there's not a lot that you can do about that right now. Currently, we are under what's called SB 91, which followed AB 3088. SB 91 is set to expire on June 30th of this year, but through the legislative meetings that I attend, there's AB 15 out there, which is attempting to extend SB 91 all the way through the end of the year. Some speculate that it's due to the recall effort, but there is now we're beginning to see talk of extending it only through September. So I think it's fair to assume that it will be extended, and if it gets extended, all of the dates that are associated with it will also be extended. Right now, under SB 91, you couldn't, you can serve your 15-day notices, and I highly encourage you to serve the 15-day notices. If the tenant returns the declaration, then they have until June 30th to pay that 25% of all the rent that's owed. If they do not return the declaration, then you are permitted to file an unlawful detainer against them. The challenge, I've seen it personally now, is when that happens, the tenant still has the ability under SB 91 to go into court, file their declaration with the court, and then the court will dismiss that case without prejudice, and you'll be left in the same boat you were in before. Where they do return the declaration, they've got till that June 30th, like I said. SB 91 specifically states that the repayment period for any of the COVID rent and COVID rent is defined right now as March of 2020 all the way through June 30th of 2021. SB 91 says the repayment period for any rent that they didn't pay during that period, if they've returned their declaration, is August of 2021 through August 31st of 2022. So that's a 13-month period they're going to have to repay that debt. It doesn't set out a payment plan, whether they're supposed to pay a certain amount every month. So essentially, they've got until August 31st, 2022 to make that remaining 75% payment. And as I've said, if I were a betting man, I would certainly bet that this is going to be extended. So the answer to your question, Chris, is if they don't return the declaration, you've got the option to evict them. If they do return the declaration, you're going to have to wait right now. Is it July 1st or will it get extended? We don't know. And then down the line, at some point, you will have the ability to seek any of that money through either a small claims action or a regular breach of contract civil action.
Now, Mr. Hall, let me ask you, because I think the likelihood of landlords collecting back rent of several months, unfortunately, is not very likely. At the same time, in the markets that I work, I would say landlords are collecting somewhere between 98% and 100%. Right? In LA City, they're having difficulties. West LA, there's some difficulties. But, we work LA County and San Bernardino County. Many of these areas, most folks are collecting the bulk majority of it. But for those that are not, what can we do tax-wise with regards to this lost rent, right? We've lost thousands of dollars. This thing has gone on for several months. Mike shared with us it may go on for a few more months. Tax-wise, you got any help here?
So tax-wise, the way it works for landlords is your cash basis set up. So what that means is you only report the income you physically deposit. So if you had a tenant that did not pay you for a full year, you simply would not report the income you didn't deposit. I mean, you have proof that you billed the tenant for funds that they have not paid on their monthly rent, but that's not taxable until you deposit the income into the checking account. So unfortunately, there's nothing else you could deduct when your unit is occupied and you're not collecting any rent. There's no additional relief above and beyond just not reporting the rent that you never collected or deposited in the bank account.
Now, Gil, with respect to the commercial loans, an investor is looking at buying a building where there's one or two tenants that are not paying. How are the lenders dealing with that in the underwriting of the property?
That's a great question. Right now, if they're not paying, they're not going to use that income at all. And they want to see a game plan as far as eviction game plan and timeframes. And at times, they're also doing a holdback up to 6 months on those 2 units.
I was just going to ask you that. So I just refinanced the building I mentioned earlier where we did the complete rehab. So now we've refinanced, permanent financing in place, cash out refi. Got a very good rate, 3.3. But they had us put up 6 months worth of payments as their security. Is that pretty common practice? And do the investors have to be prepared as they're looking at a purchase, not only the down payment, but say up to 6 months of the mortgage payments?
Depending on the building and the number of vacancies, we can get to the point where some lenders are just going to pass on the property altogether, where they won't lend on them. So if you have a building over 20%, non-paying, you're going to have a problem. It's not as easy as it was anymore. Lenders are really looking at that pay history, and they're financing, to a certain extent, the tenant now. So that's what they're looking at. They're looking at production performance. So if the building's not performing and you have 20% non-payment, you're going to have an issue. It's not every lender's loan. Now, there still are lenders that are lending to that, but they're going to have the caveat of holdbacks or some penalties. Obviously, your LTV is going to be reduced because of debt service.
But let's talk about payment history. If it's a refinance, what stops a landlord from saying everyone's paying? In other words, are the lenders asking for any specific documentation to prove payment?
That's a good question. I think we had that conversation before. I think in, 08, 09, they were actually asking for canceled checks or bank statements. We haven't gotten to that extent yet, but everything really needs to look feasible. So if we're showing an operating account, and that operating account is that tenant's account only for that building, they have the data. So the data can be a little more intrinsic as far as them reviewing the data. So it could happen. Will it happen? I think it's leading to that. especially where more buildings are getting a little more vacancy issues.
Now, Mr. Spear, let me ask you, so in a sale transaction, the seller does not disclose to the buyer that the tenant is behind on rent. They figure, you know what, it's a wash, I'm happy I'm just selling. When the rent statement comes through escrow, I'm just gonna fill it out as though everyone's paid. Then they can just, that gives the tenant the ability just to start new with the new owner. Any problem in that?
Well, what you're saying, if I understand correctly, is the seller is thinking, well, the truth is I'm not getting paid the rent, and so what I'm going to do is I'm just going to say I am getting the rent. So in other words, they're going to lie to the buyer. This is the definition of fraud. In California, a seller must disclose in writing all material defects in the subject property. The safest way for a seller to look at a sale is to not just disclose material defects in the subject property, but to disclose all, not just material facts, not just defects, that might remotely be of interest to the buyer, not just in the subject property. If you do that, you greatly reduce the chances of ever being sued by a buyer. So one of the things a buyer would be interested in knowing is whether the property is performing. As Gil says, their loan is going to be based upon that. They're going to make representations to their lender based upon what you're telling them as a seller. It's going to, as Mike would tell you, it's going to be a legal requirement that you tell them the truth. So when you don't tell them that people aren't paying rent, you open the door for later on the buyer to come back and say, you defrauded me, you misrepresented the property, that tenant was not paying the rent, those tenants were not paying the rent, I just want you to pay me all that back rent yourself. The simple solution, especially now during COVID, is to explain that that rent is not being paid, to do it in writing, because the buyer will understand. They've heard of COVID, they understand what's going on, they're buying a property in the middle of COVID, they'll understand that. And you immunize yourself against a lawsuit for everything you tell the truth about. So tell the truth, it's that simple. To not tell the truth, to omit the truth, to fail to tell the truth, the whole truth, or in nothing but the truth, is to expose yourself to a potential lawsuit you just don't need.
Yeah, and so we have seen this in transactions where there is non-paying tenants, of course, but to your point, Steve, the buyers move forward. They wanted to know about it. They wanted to know for how long, what actions have been taken. Of course, that becomes a function of the price as well, but they still move forward. So for the question of our property selling, if there's non-paying tenants, everything's a function of price, I'd guess you'd say. Mike, the state of emergency is when the state of emergency is lifted, do we go back to 3-day notices to pay rent or quit, along with all other legal notices and mechanisms in place prior to the pandemic, or have those been lost forever?
So that's a great question, but I want to clarify it because there's a difference between SB 91 and the laws that come out of the state versus what you just described as the state of emergency. There's a state of emergency for the city of Los Angeles. There's a state of emergency for the county of Los Angeles. There's a state of emergency for the state of California. So let me start with California. Let's just call the state of emergency magically lines up with SB 91. And when SB 91 or AB 15, whatever it ends up being, expires, do we go back to the 3-day notices? The short answer on that is yes. When the state of emergency is lifted in the city or the county of Los Angeles, do we go back to our 3-day pay or quit notices? Maybe, maybe not. It'll depend on where we're at. Can you serve notices at all after the state of emergency is lifted in the city or the county of LA? The short answer to that is no. They have a period, both of those moratoriums have a period after the expiration of the state of emergency in which landlords still can't serve notices. I believe the city of Los Angeles is a year, and I want to say the county of LA is also a year. It's either 6 months or a year, but I think it's a year. But the point is, state of emergency is 3 different levels. Will we get back to the 3-day notices? Yes, we will. Is it going to be June 30th? Highly unlikely. I suspect it'll be probably toward the end of this year. It'll hit either in the fall of 2021, where a lot of, the goal right now, Governor Newsom, 2 things that Governor Newsom did recently. He's announced that he wants the kids to go back to school in fall, which is fantastic. And I think that that will lighten the burden that the people who are working from home will be feeling, and that'll help out quite a bit. And I think that once we get past that hurdle where the children are back in school, then I can anticipate seeing the end of SB 91 and all these moratoriums. Until that time, serving notices, we're not anywhere near serving 3-day notices right now.
Now, of course, January of last year, prior to COVID, we had rent control come into our lives. And so this question is there a chance for California rent control to be lifted, or will the laws become more stringent? What do you think, Spear?
Camel's nose in the tent is what I think. This is part of what I would call political salami slicing tactics. You put in a rent control that says 5% plus the cost of living, a CPI index, which is what it is now, and later on you say 4% plus, and then 3, and then 2, and then 1, and then 0. You just say it's the cost of living, and then you say, well, it's actually going to be more than the cost of living. So this is the trend for the people who advocate for rent control. So I think that you have to plan on there being rent control going forward when you own. You should also plan on there being laws that say you have to stop at stop signs. That doesn't stop you from driving your car. There are speed limits. There are places you're not allowed to drive. There are requirements that you drive sober. It's going to be the same thing as it always has been with landlords. If you go back to the freewheeling days 50 or 80 years ago, when a landlord could just run a slum and there really was nothing a tenant could do about it, that's changed. And all of us who own apartments, who manage them properly, can still make a great deal of money doing it right. So when you have rent control, supply and demand will still be a powerful engine for controlling rent control. You'll have situations we have the experience with in the city of Los Angeles, and for that matter in New York City and in San Francisco, as to what happens when rent control comes in. Landlords will still make money. You'll be just fine. You need to understand the rules, follow the rules, but don't be afraid of the rules. This is not a reason not to own real estate.
Next question, kind of on the back here of rent control. Can and should we currently raise our rental rates? Is there a way to obtain market rent for a unit without doing substantial renovations? So, Brendan, I know you want to pounce on substantial renovations, so I'll leave you for last. I'm curious just for general opinion. Hall will come to you. Do you think now's the time to issue rental increases?
Yes, I believe that it's a great time to raise rents because there's a shortage of supply of inventory of rentals in the marketplace. And with inflation rising, it is going to be important to raise those rents as often as you can to keep up with the pace of inflation. For example, a sheet of plywood went from $30 to $105 in the past 18 months. A client of mine told me that plywood has literally almost tripled in price. So you're going to start seeing materials rise in price as you do your renovations and your maintenance on your building. So it's going to be important to continually raise those rents to cover your costs.
Gil, what say you?
I think it's very property determined. Depending on the environment, the temperature, the mood of the client, I think it could be dangerous. I think you have a rent strike on your hands. I think you have to have your finger on the pulse of what's happening in your building. Are people content? Are they working? Are they cash flowing? Are they able to pay you? If that's the case, a potential rent raise, absolutely. If it's not the case, I wouldn't advocate it.
Bruce?
You know what? I leave that answer to the people that I hired, to be quite honest with you, because they know the marketplace. So that's I would delegate that to the team I interviewed and said, okay, this is your field. What do you think? Honestly, I would do that. I might have an opinion of it, but I would bounce it off the people that I hired and say, you tell me the marketplace. What's the demand? We raise rents. Do we lose the tenant? I want to know that, and I want them to understand I'm perfectly fine and content if what they say is to stay where we are. I'm going to take their judgment because I went through a very good process to get to their company. I trust that. That's my process. I trust.
But I could see one or two side effects to deterring to the management company. Because they're motivated by your gross rent collections, they may say, maybe not your company, Bruce, because you vetted them, but there are management companies that may say, yeah, let's push the rents because their money is a percentage of your gross rents. Or the other side of the spectrum where you have a lazy management company, they don't want to get out there and do the work necessary to obtain market rents for you, and so hence you fall behind. And I've sold buildings where our clients are in that situation. Our clients had no case because, let's say, had no idea of the case because, let's say, they lived out of state or what have you. The management company is telling them, oh yeah, this is as far as we can push rents, and they're 20% below market. So I don't know how you know.
Well, in my interview process, I do two things. I give them a chance to be dishonest in my favor. I said, let's give a scenario. I've got mold, but we can cover it with paint. And is that something that you would do on my behalf? That's a loaded question. They need to stand in front of me and say, no, I'll never do that for anybody. Done. Second thing is, okay, this is how I'm not bothered by property managers. You have my permission to do whatever is in my best interest and what you would do for yourself. When you do that, and let's say you do that and I disagree with the outcome, no one's ever going to be in trouble, but we'll discuss what might have been done differently, but you don't need my participation to do that. That's how I'm left alone. But I do check the honesty, because if they want the business and they lie on my behalf, done.
Spear, your thoughts on rental increases at this time?
I think it's a two-part test. I think the first part is the humanity test that Gil Figueroa mentioned, which is, are your people okay? Are they employed? Have they been paying the rent? Are they able to pay the rent? Are they content and happy? Have you done your job as a landlord to provide a clean, safe space? And are you running the place the right way? That's the first question. The second question is, what's the market? If the market is above you, then you should raise rents. My general rule when we're not in a pandemic is raise the rents every single year, even if it's by $5. Because the question for your tenant should not be, is the rent going up? It should be, how much is the rent going up? There should be no question about that. It should be built in. No one does themselves any favors, and particularly not in an environment where rent control is here and is coming, by leaving rents below market. If you want to give to charity, your tenants are not the people who would typically be the object of your charity. You would pick a charity and you would give to charity. So make all the money that you properly should, morally, ethically, legally, and based on the market, by running your apartment buildings correctly, and then give generously to charity. That's the place to give your charity. Giving charity to tenants by leaving rents low makes you vulnerable to rent control that prevents you from raising it. It also hampers your ability to sell your property for full value, since your sales price is based in significant part based on the cash flow of the building and the net operating income. And so you need to keep your rents at market. If you're below market and the humanity factor works, raise the rent.
I have one more comment to make, Chris. Steven,
yes, sir.
Steven, you make some good points. I want to, just to the listeners on this event, I want to be very clear here that we have inflation. And if you have not had an opportunity to go to Home Depot to look at prices, go to Home Depot after you listen to this event and look at the prices of plywood, look at the prices of plumbing materials. And if you're substantially under market, you need to revisit those rents and make sure you get to market or slightly below market. It's going to be important for your livelihood on your cash flow with what the cost of materials are these days. And that's going to be important. And I agree with what Bruce said and what Steven said about, and Gil, that you want to have a conscience too, where you don't just go over market or you're raising rents on a tenant that's having a hard time, et cetera. But you definitely don't want to be substantially under market either, because I've seen some clients that have joked around and said, oh, you know what, I need to start raising my rent. I haven't raised my rents in 4 years. And I agree with Steven. If you're going to raise your rent, raise it maybe $5 or $10, whatever the number is. But keep that in mind because materials have just exploded in price. And it's important to be cognizant of that point.
We have inflation coming our way, and it is inevitable that we're going to have it. My comments about what happened in the 1960s with President Johnson and what is happening now with President Biden, if you underreact to inflation in any way by not sufficiently investing, by not keeping your rents up, by not controlling your costs, by not passing on costs to tenants as you should, as the market will allow, and as proper morality and ethics will allow, if you miss those opportunities, you will be financially hurt by it at the very least.
Can I ask a quick question? Because you guys are experienced at the apartment world. How does inflation going up affect cap rates willing to be purchased at?
We've seen a tremendous compression in cap rates over the last 20, 25 years. I remember when I said to realtors that I was not interested in buying any property in Southern California below a 9.5 cap. And I was buying properties at 10, 10.5, 11 cap. And this is in the 1980s. Cap rates now are dramatically lower than that. Cap rate, just for everyone, is the equivalent of price-earnings ratio, the equivalent of EBITDA for real estate. It is the earnings after all expenses, assuming you own the property free and clear, but not including taxes, depreciation, appreciation, or interest. That's cap rate. And it's effectively a multiplier to decide what to pay for your property. So it is possible that cap rates will decompress over the coming years or a decade or two, and that would result in lower prices. But inflation is the opposite of this, and I think the winner of the competition between decompression of cap rates and inflation is going to be inflation based strictly on supply and demand. It is a matter of if you have enough buyers who want to own apartment buildings because you have enough tenants who want to live in apartment buildings, that's going to support lower cap rates, higher prices.
So let me ask you, Steve, with respect to the inflation component, because right now we find that tenants in many markets are spending at least 55% of their discretionary income on rent.
Wow.
If inflation comes and now your strawberries cost more, I mean, because there's a lot of talk about building materials, and some people may argue, well, that has to do with COVID, right? Home Depot stayed an essential business while the lumber yards didn't, so they weren't making any lumber, hence you're paying a lot for lumber, but that's gonna go away. That's just building materials. But everything else, your groceries and your gasoline, if the tenants are spending more and wages stay stagnant, thus rents I don't see really going up, do you still think we have that compression on cap rates?
Yes, because wages are going to go up. Here we are at the beginning of June, and we have heard that you can't find enough employees, and there are a lot of different factors for why you can't find enough employees. And so the sense of it, when you listen to some of the politicians talk, is, well, just pay them more. Just pay them more and they'll come work for you. Well, that's true. The implicit statement that isn't being said out loud is, and raise your prices. So the restaurant that has to pay more money for someone to stand in the kitchen and cook or stand in front of house and serve tables, that person is going to charge more for a cheeseburger. And that's inflation. And in turn, everything will move up, the prices will move up. I think that you won't see wages remain stationary. You'll see them go up. They'll go up with supply and demand when someone wants a worker to work for them. We see people now, I have clients of our law office who run businesses who are paying signing bonuses to people, who are paying more than they've ever paid. They're telling me privately that after this burst of recovery from COVID happens, they'll lower the wages back down. Well, they won't. They'll end up raising their prices because they won't be able to keep the labor if they lower the wages back down. They'll have dispirited employees. It won't work. But they'll raise their prices, and they'll be able to because their competitors are raising their prices. That's how inflation happens. This is exactly what happened following President Johnson's war on poverty. In the 1960s, we had stagflation in the 70s. We're headed there now. Not sure how the government will react to it, not sure what's next in terms of spending and the next bills that are proposed right now by the administration to the Congress. Not sure what'll pass or what won't, but what we know for sure is we already have the recipe in place for inflation. So no, I don't think it decompresses cap rates. Does anybody?
I do.
Bruce does. Bruce, tell us.
That I think that your cap rate's going to go down?
No,
Excuse me,
up.
go up? Yes.
Why?
You know, your first, I mean, there's a lot of things about California, which is one of the reasons why I'm not here. And so, but I'll just give you the attitude of the owner. Speaking in front of an apartment owner association, had about 400 people in that normally are in the room. This had like 500 people. They were lined on the wall. And I looked out the audience and I said, wow, you guys are either really excited or really scared. And they laughed, and then somebody stood up and we said, we want to know if apartments are in a price bubble. I said, I'm not an apartment expert. And by the way, I love to be on this panel because I get to bat it around with smarter people than I am. And so that's very cool. And I said, I'm not an expert on apartments, but I can ask you one question and you'll tell me, would you buy your own apartment building at its current evaluation? And 400 people laughed. And that was stunning to me because I thought, okay, they know that this cap rate is unrealistic. So I understand what you're saying, but let me just ask another question. And again, I'm asking because I want to know. It's one of the reasons I came from Florida today to do this live. When we had the inflation in the 60s and 70s, you had the baby boom generation that were coming into their biggest spending patterns. You now have them being a driver in retirement, and the workforce is declining, and your velocity of money is going down, and you have inventions like AI and robotics that are deflationary. So I guess this picture to me looks different. And honestly, that was one of the questions I wanted to ask is, do you see that countering inflation? Because we don't have inflation for real. We have artificial. Here, let's throw $4 trillion in the economy. You're going to create inflation as long as that goes. But once that stops, do you have the driver? I don't know that I know that.
So I think what you're talking about is the notion of the greater fool theory. I know I'm a great fool to pay this much money for an apartment, but it'll be okay because I'll find a greater fool than me to buy it from me for even more. And that isn't true inflation. That's a mistake. That is a bubble. That is something that's not going to end well for the person who buys on a speculative basis. But we're not buying a house, we're buying an apartment. And the question is, will that apartment generate revenue? You're buying a money machine. And if you pay too much for the money machine, it doesn't make enough money, then no, that'll be a bad deal. But if the engine behind the money machine, that is tenants who need a place to sleep and a place to live, if that engine, if population continues, then the demand continues and the price support is there. So if you own apartment buildings in Birmingham, Alabama, and those apartment buildings are you can buy an apartment there at a 20 cap rate, But if one business closes, that your entire apartment building will be completely vacant because they laid off 6,000 people and everyone in your apartment moves somewhere else to find a job. The employment bone is connected to the apartment bone. And so if you are in an area where there are jobs, a variety of jobs in variety of industries that are not dependent on one company or even on one industry, and that's the definition of most of California, then the demand is there, the support is there, you have a housing shortage which is not going to be solved anytime soon. It's going to go on for another decade or two, as long as the government keeps moving in the opposite direction of solving it, and the demand will remain high and cap rates should remain low.
So the second part to that question, Brennan, is there a way to obtain market rent for a unit without doing substantial renovations?
I know a strategy that a lot of my clients use. You have to define substantial renovations first. What is a substantial renovation to you versus California law. Substantial renovation under
AB 1482.
1482, 1946.2 is anything that touches the apartment systems. So right now, can you get market rent without doing a substantial renovation? Tell me if I'm right, but it sounds like what you're asking me is, can I get my tenant out? Right now, you cannot get a tenant out under a substantial renovation. That's part of SB 91. You're not permitted to do that. So what can you do? So now we go into a different definition of substantial renovation. I have clients that will get 1 unit vacant. However it takes them to do it, they don't care. They'll buy somebody out and pay them way more than they need. Then they will take that unit and they will do a substantial renovation. And then they will offer that unit to the existing tenants in the building at a less than market rate. And it's not hard to get somebody to move into that. And now
Then
you've
you
got
go round
another
robin.
unit. And that's all legal within SB 91. There's no problem with that at all. So, like I said, what it really boils down to is what's your definition of substantial renovation? If you're talking about under 1946.2, no, you can't do that right now. But if you're talking about a legitimate renovation and freeing up a unit and then putting your existing tenants in there under a new lease, completely doable.
But
If the work you need, Mike, to do for substantial renovation requires a permit, does that make it a substantial renovation?
Not under the law. So let's talk about the different levels of law. Under California law, you're not required right now to have a permit or even required to pull a permit for it. All you're required to do is to be working on the plumbing, the heating, or one of the systems of the building. So going back to the question is, do you have to pull the permit or does that change it? Under state law, you don't even have to pull the permits. And I should say that is one of the modifications that I'm hearing about up in Sacramento is they want to change that. They want to change that so that the permits are required and you actually have to pull them first. And Inglewood just recently made that change to their own local rent control ordinance. So you're dealing with all these different layers of laws that you have to sift through, but that is changing. Yeah, a substantial renovation in many jurisdictions requires you to pull permits first and present them. And then that's going to be determined, if that's a substantial renovation, will be determined by that local building and safety.
And so to this question, I really, like you mentioned, I think the heart of the question was, can I just get them out and not do anything and save $1? You can't. I mean, that's the reality. You can't just give a 60-day notice anymore.
Oh, no.
Yeah.
No, you
and
cannot.
That's the reality.
You cannot give a 60-day notice. Under SB 91, all properties, even single-family homes right now, fall under the requirements of 1946.2 for what they call a just cause eviction. Whether it's no fault or at fault is irrelevant. So all properties fall under 1946.2. You cannot simply terminate a tenancy right now. You need just cause. That's at the state level. Now, moving down to a local level, they're even more stringent. Many of those, the list of just cause under 1946.2 is fairly decent. It's a decent list. But when you get down to the local moratoriums like LA City and LA County, they knock them all out and say LA City, you can't serve any notices. So no, getting somebody out right now is next to impossible for Los Angeles or LA County for a just cause reason. Going back to it, the only real reasons in LA City are, for example, that you've got a real health and safety issue, which happens a lot, or you've got a tenant that is literally beating somebody up, or there was a police raid on the property or something along those lines.
So, Mike, if you, in California, the California rent control law says that the cities, the local governments can give even more stringent rent control regulations than the state. But on the state level, this applies to single-family residences and what else?
So let me clarify. That's a great question because maybe I wasn't clear about that. SB 91 is the COVID moratorium. SB 91 is what places all properties under 1946.2. That's temporary. That will go away either June 30th or whenever it gets extended to. So if you weren't dealing with COVID, under 1946.2, which is statewide rent control, not all properties are covered by that. So a single family home, yeah, you could typically serve a 30 or 60-day notice. But right now, all properties fall under that requirement.
So after that temporary is gone, what is the rent control law? Who does it apply to? What does it mean?
So it does not, let's talk about the exemptions. Single family, there's a whole list of about 14 exemptions. Single family homes are exempt in general unless they're owned by a corporation. Dormitories are exempt. Duplexes in which the owners live in one of the unit are exempt. Owner-occupied units are exempt. And the overarching exemption is for any property that is less than 15 years old. In other words, the certificate of occupancy was issued less than 15 years ago. So it's kind of a moving target, and you have to keep that in the back of your mind. If you have a multifamily and you're not living in it, which I think that's what most landlords are dealing with, if your property is more than 15 years old, statewide rent control is going to apply. If it's less than 15 years old, it's not going to apply right now, but when you hit that 15-year anniversary, it will apply.
Or when they shorten it to 13 or 12 or 10
Unless they
years.
short. Well, that's a great point, because one of the questions that was asked was, do we see California rent control going away or sticking around, and do we see it becoming more stringent? As far as it going away, I have two words: heck no. As far as it becoming more stringent, absolutely. What I anticipate seeing is all of this stuff is going to come together. And what I mean by that is right now, Stephen's exactly right. 1946.2 says that a local rent control or eviction control ordinance that's more stringent controls. The patchwork that creates is very problematic. And so the cries we are starting to hear, and we've been hearing it ever since statewide came into effect, is that they want to bring everything under the one statewide. To do that, though, what is going to happen to the statewide, and Stephen stole my thunder by saying this earlier, was the camel's nose is under the tent. You ain't getting that camel out. So what's going to happen is statewide is going to become more and more and more and more stringent so that they can say, hey, this doesn't make sense. Let's swap out all these patchworked ordinances for one statewide law. But when is that going to happen? It could be 10 years. Who knows? Nobody can really predict that.
And if you're still somewhat puzzled as to AB 1482, SB 91, Mike and I recorded 2 separate interviews, each about an hour long, that you can find on our YouTube channel. And I also sat with eviction attorney Dennis Block to break those apart as well. You can go to YouTube, look up The Apartment Dealer. Plenty of content there for you. I would respond to this question in that why not do substantial improvements? And here's why. In 2019, as talks ramped up for rent control, I purchased a property in the city of Ontario. The videos are all on our YouTube channel as well. Long and the short of it is we revamped the whole building with some substantial improvement. That property sold for the highest price per unit any building of its age has sold ever in the city of Ontario. Then, right after that, I did a property in LA County unincorporated. That property sold for one of the highest prices per square foot. And here just recently, I finished a building in Covina doing substantial improvement. I mentioned earlier our rents are 13% above market during COVID. I'm sure it's only going to get better after COVID. But I mentioned earlier as well that we just did a cash out refinance. That property appraised for at least 15% above value because of the renovations that we had done. And what does that mean? That means that we pulled out more of our capital that we had into the deal. We pulled more out because, again, they gave us a higher valuation. 1, based upon those higher rents. 2, based upon the quality of the asset. So we're going to show a quick snippet now, a video that I had recorded that really breaks out substantial improvements, why you should consider it, and why it really helps you move from pillar 1, which is maximizing your current holdings, which is substantial improvements, to then move into pillar 2, which is growth in terms of the size of your portfolio and cash flow. Let's look at that now. Welcome back to the Apartment Dealer Show. Today we're going to discuss the first of the 3 pillars of building one's financial legacy. Anytime I reference what you and I are doing when we're purchasing multifamily properties, I reference that we're building a financial legacy for ourselves, for our family, for our heirs, for the future. In building that financial legacy, I see it as there being 3 foundational pillars. The first pillar is maximization. And I would equate this to getting your financial household in order. What do I mean? With the current investment properties that you own, how do we increase our net income? Because at the end of the day, name of the game is cash flow. And how do we increase the property's value from within? Why do we want to do that? So that we can then transition to pillar 2, which is growth. Growth being more units, more cash flow, and the compound effect that comes with that. And then the third pillar is preparing for tomorrow. This is when we begin to contemplate exiting real estate. What are the strategies to do so while mitigating our capital gains exposure, as well as considering the next generation behind us, those that we may leave our properties to in the future. So the first question is, why? Why should I work on my current properties? Given all the recent legislation here in California, given rent control, just given the difficulties when it comes to owning multifamily property, I would say that's exactly why you want to maximize your profits and maximize your property's value. Look, yes, there is rent control here in the entire state of California. And some of us have a rougher batch of this. Some of us are governed by only a 3% annual increase, some 5%, some 5% plus CPI. And who knows when you're watching this if that's all been changed depending on where you own. But the point is that given the risk involved of owning multifamily property, and yes, it has got more difficult, shouldn't we earn a greater rate of return for our risk? Shouldn't we do things to improve our property's value so that in the future there's that much more equity for us to capitalize on? Within the rent control law, now speaking to AB 1482, there's a provision of which if you do capital improvements, you can actually still ask tenants to vacate your units. And when we're looking at this, we have to take a look at what's the current tenant paying in terms of monthly rent. What do we see as the potential market rent? And given our discussion here on capital improvements today, oftentimes we're getting 5, 10, 15% even above high market value in terms of the rents we're able to collect once we do the right type of capital improvements. But the bottom line is, let's say you can increase where you own currently by 5% annually. But what if you could increase that rate of return, say, by 15%? See, that's the question here. And it really is an analysis of what are you currently collecting? What's the potential? How much does it cost to get you from where you currently are to market in terms of the improvement of the unit? Now, when it comes to condition of property, by now I've sold over 300 multifamily properties on behalf of clients. My wife and I own our own properties ourselves. I've seen many, many buildings. And more times than not, upon doing an inspection, we walk into a rental unit and you walk into the living room and there's one type of tile. You turn into a bedroom, there's another type of tile. You go into the bathroom, there's a really interesting choice of tile there. You go into the kitchen, yet another type of flooring because that one was on sale at Home Depot. You take a look at the kitchen and it's the old 1960s cabinets and all the owner has done is maybe painted over them. And maybe there's one, if you're lucky, one new cabinet on this side of the wall just because that one broke. And some people call that a day in terms of, hey, technically I have tile floors or I have wood laminate floors. Technically I tiled my bathroom. Technically I've updated the kitchen. And I'm not here to knock anyone's way of management. All I'm suggesting is there's a better way so that you can obtain a different type of tenant that can pay you substantially more money and so that you can increase your property's value. So you say, Chris, but how? How do we do that? We have rent control here locally. As I mentioned, within the rent control bill, they did allow landlords, if you do substantial improvements, and we'll put the verbiage here, you have to check a couple boxes here. Number one, it has to be a substantial improvement. Putting new cabinets in the kitchen does not count for substantial improvements, I'm sorry to say. It's things like electrical, plumbing, and they even notate those specific items in the bill itself. Second, the improvements that you're going to do would have to cause you to pull permits in order to do the work. Third box, the work must take, or I guess look to take more than 30 days. Check those 3 boxes. You can give your tenant And now check your local city, but in most cities, you can give your tenant a 60-day notice to vacate. They have to go on their way, and now you've taken possession of the unit. Now, before just doing this, of course, it goes back to the analysis. What's my current rent? What can I get for market? How much more above market can I get depending on certain improvements that I'm pondering? Now, you can go to our YouTube channel. I've actually shared videos of my own personal properties so that you get an idea of what it is we're doing in our own units, what type of materials are we using, finished materials. We've even done full financial analysis in terms of what's the final outcome in terms of the rental income, just to show you real life, how do you apply this provision within the law? How does it apply to you? What, if any, difference would it make within your properties that you hold now? So let me introduce you to the millennial. The millennial is the largest part of the US population today. These individuals now are in their late 20s up to their late 30s. They fit the profile, as I just discussed, and they're willing to spend more than 50% of their discretionary income on rent, so long as you have the right amenities. So let's talk improvements. Now, what you're looking at now is a photo of a property that my wife and I own, and you'll see what condition it was when we purchased the property. That was the previous landlord's idea of a rental unit, I guess. Some people allow their tenants to live like that. We choose not to. Why? Because I knew if we did the right type of capital improvements, we'd get a different type of tenant and a significantly higher rent. Let's say I would have left the unit in its previous condition. Given the community it's located, maybe I would have been able to collect $900 to $1,000. We did the capital improvements, as you see, which included new plumbing, electrical, windows, kitchen, bathroom, flooring, paint, recessed lighting, the whole nine. And we collect about $1,400 today. There's a significant difference, 40% more in rental income. And the tenant that I have is, guess who? It's a millennial, no kids, not married, 2 incomes. We're actually going to share some footage from our last live educational event that we hosted for landlords like you. And at that time, we had just opened escrow on this particular property. Flash forward, today we now have that property in escrow. But let's first take a look at how that deal started out. This is a property that I just purchased in Ontario. Now, my escrow is going on while this rent control thing is heating up. This is a 5-unit property, and the tenants, if you can believe it or not, were paying $750 and $800 per unit. The woman who sold the building actually built the building with her husband, and they had owned it since the 1960s, and apparently never raised rent. How that hurt her, I didn't represent her. I bought that from an agent. It was on the open market. Maybe some of you saw this deal just a couple months ago. I ended up buying it, 5 units, all 2-bedroom, 1 bath, single story, good size units, big backyards, $760,000. Good buy. That woman, the seller, who was elderly and retired, and she was selling and riding off into the sunset, would have obtained at least another $150,000 for the sale of her building had she had the right rents in place. I wouldn't have been the buyer at that point, but somebody would, knowing values in the area, somebody would have. Now, so I mentioned I'm in the middle of rent control while this is going on. To understand how this works, if I would have gave the tenants a notice to increase rent when I took over in September and August, the rent control bill has a rollback feature, meaning whatever your rents were in March 15th, everyone in this room gets to take their rents back to what they were on March 15th if your last rent increase was more than the proposed rent cap. You follow? So if your tenant was paying $1,000 on March 14th and you gave them a $100 rent increase, that's 10%, on March 16th, you get to go back to $1,000 come this January 1st of the new year. That's how the rent control bill works. So my escrow, $750. Even if I would have worked something out with them to say, hey, let's agree on $1,100. Market is $16. Let's agree at $1,100, which is what I would have done. It becomes law. Now my rents would have went back to $750 Can you imagine raising rents 7% on 750 once per year for the coming years? Makes no financial sense. So the government forced my hand. I gave everyone a 60-day notice to vacate, all tenants. 4 of the 5 will be out come this Monday, and we're gonna start our construction. And we'll do the same type of rehab that we've done. Now, to sweeten the deal, Stephen Hall assisted me in purchasing this property in a investment trust where my money that sits there in the trust is non-taxable. The growth in the property is non-taxable. I put my rents into this account and they're non-taxable. This is why we bring people like Stephen Hall. For the financing, now, any bank was not gonna lend me a traditional loan, even 50%, even a 40% loan to value, given the rents. Bruce Norris and his firm has a loan program. They lent me more than 76% of the value at purchase. And so you understand now, my leverage, I maybe put 24% down. It goes in an investment account. We're gonna do the major capital improvements, bring them up to market. That's the idea when we say maximization.
So now, where are we today? That property is actually in escrow to sell. And assuming we close escrow, buyer has already removed all contingencies, so we assume there's no reason why we won't hit the finish line. It will be, if not the highest, one of the highest priced sales on a per unit basis that we've seen in the entire city.
So the bottom line is substantial improvements bring about 4 things: above market rents, an ideal tenant base, increased property values, and more tax write-offs. Why would you not consider doing substantial improvements to your property?
I am always struck when a landlord says, I don't want to spend money on improvements, and they feel like they're spending money. They feel like it's a consumer item of some sort. They spent a tremendous amount of money buying the property, and then they don't want to spend money to improve it. I've never understood that. You make money when you improve your property in a way that allows you to raise the rent. You make money when you improve your property in a way that allows you to sell it for more. I've never understood that. It's not a consumption. It's not like spending something on an expensive dinner or an expensive car that will only go down in value. It is something which should make you money if it's done properly. So I agree with that completely.
I'd actually like to add to that, bringing it back to something we talked about this morning. Spending money on capital improvements acts as an insurance policy. What do I mean by that? I'm seeing the increase in habitability claims. I'm seeing the increase in fair housing claims. I'm seeing an increase in general litigation against landlords. And when you can demonstrate that you have a record of going in and making the capital improvements and not just putting a Band-Aid on a bullet wound, as they say, you have a lot more credibility when it comes to these habitability claims. You've got a nice building, everything looks good, and assuming you did your due diligence correctly and documented everything well, and then you get sued for habitability because the tenant's upset at you because you evicted them, you go in and you take pictures of that unit, and realistically speaking, the capital improvements or the money you spend, as I said, comes back to defend you in that litigation later. So again, not only does it increase the value of your property, but it decreases the chance of real hard litigation in a habitability claim.
Chris, with that being said, we have one lender that is agreeing with that position, and what they're doing is they're allowing for market rents. What they're doing in underwriting analytics is they're using 2 years of maximum rental increase. So whatever that city is allowing, plus CPI, they're allowing for a 2-year component. So in most cases, that's 15 to 16%. In an actual loan that we just closed, we had a building that did have that ability in market rents, and on a regular 1.20 debt service product, the owner was only getting $550,000 or a 50% LTV. Using that 16% in market analysis allowed us to get $700,000 and increase our loan to value to 64%. Now the beauty of this bridge loan, it currently is at 3.75 interest only for 2 years. So it's a beautiful add-on to that repositioning aggressive position. So for those people that are very aggressive and want to have a strategy of paying tenants out or the ability to get tenants out and reposition a property, this is a perfect product.
If you have a
result.
10-year T-bill, let's say, that gets to 6%, does that impact an apartment building?
Yes,
Absolutely.
there's no question. Go ahead, Gil.
So historically, when the T-bill was at 6%, what were our cap rates? Were they different? I would tend to say yes. We had tremendous different cap rates. So maybe when T-bills were 6%, maybe our cap rates were 5 or 6 or even 7. So my point is, it's a derivative. You can't change the derivative. Now, to give Steve merit of what he's saying is supply and demand, we'll take a city like New York City where cap rates are 1%, but yet values continue to go up because of supply and demand. So I think there's two different components. One component is whether it be cash flow or there will be value as far as inflationary value. But technically, you cannot have both. It's one or the other.
That's a very good point. I think that's correct. You're going to have inflation if it happens the way it looks like it's happening will be the economic tragedy of our time, because the rich will get richer and the poor will get poorer, and there will be social consequences and political consequences to this, and dissatisfaction and things bordering on anarchy. This is a problem. And so when you have tremendous wealth being accrued in net value, but the income isn't there, that could drive prices down. It could drive civil unrest as well.
What's really interesting about the single-family home affordability number that just came out is we've had a 17% increase in price. Interest, let's say they were pretty stable. Your affordability number barely went down 1%. And the way they figure affordability is bands of income. It's not median income. It's not average income. It's how many households make enough to get a yes answer from a lender. Well, that is at 27%, which is 10 points above where you stop going up in real estate. And it's because now, and yet we're losing migration by several 100,000 people now going out. But who is staying and who's coming are making enough money to keep that affordability number high, despite the fact on the huge price increase. That was stunning. I didn't expect that.
Now this rolls into the next question that's on the landlord's mind. This market feels like a bubble. Is this growth real? Now here's a couple of things that I'll mention is that CoStar Group, which if you belong to our email list weekly, you've been receiving what CoStar releases, these economic updates. And who CoStar is they track analytics in the commercial markets. They have no horse in the race in terms of whether you buy or sell real estate. They sell the analytics to brokers like myself. They just found that the growth in rents this year, if it keeps pace, will nationwide, is going to equate to about 9.1%, and that'll be the biggest gains in rent in not just the last decade, in the century, this year.
Wow. Okay.
So you have things like that. Now we're talking about California real estate. You also have, Bruce pointed to migration. And Bruce and I recorded an interview where we went through this pretty extensively, but just think about this. Here recently, California lost a seat in the House of Representatives because our population dropped, versus some states like Texas, they picked up 2 seats because their population grew. Well, what does that do to California real estate? So, is this a bubble? And let's go to Mr. Stephen Hall.
Interest rates are driving the cap rates right now because, like we talked about earlier, there's interest rate compression. I don't know if this is quite a bubble. This is a hard question to ask. Is it a bubble in certain areas? For example, Chris, you used to give us a breakdown of what appreciation rates were happening in what county or what area of the San Fernando Valley. I think there's certainly a bubble in the C-class properties where they're trading almost at the same rates at the A-class properties. I think there's a bubble, but I don't think there's a bubble in the A-class grade properties client base. If your client base is B+ grade and up, I don't think you're in a bubble. But if you're a C grade asset, it's definitely a great time to sell because I think that those assets are definitely overvalued in comparison to the quality of the tenant, especially when we were talking about inflation, because with inflation that could kick into high gear, those folks could be harmed and those assets could definitely be affected by the lack of job potentials, et cetera, or survivability of that kind of a tenant base. And take it a step further, when Steve Spurrier, you mentioned anarchy, or you mentioned the social unrest, the idea of social unrest, I'm thinking of insurance. That I remember in the 90s when the LA riots happened, that the merchants did not want to rebuild in South Central Los Angeles because the insurance companies would not insure the risk of those stores in that specific area of the city because of the risk that was associated to the riots. I could see C-class properties having those kinds of issues down the road if we see civil unrest with certain demographics, depending upon where these properties are located. So that's my long answer of saying that it depends on the quality grade of the asset. That I don't think we're in a bubble in A-class type real estate, but I think we're in a bubble for C-class and below.
Now, Gil, you track the interest rates. Of course, there's much talk about interest rates because they're back at historic lows again. I know you have some charts to share with us, what you see, and then if you can take that and address the question of, is this a bubble in the market?
A bubble is perspective. I mean, right now we're having art, crypto NFTs going off, something that most of us don't even understand what in the world is happening. We don't know how this crypto NFT is worth $50 billion. So that to me is, in essence, a overextension of value. And anytime you have an overextension of value, you have a correction. I think right now we're in a market correction. We could see a 20% drop in the market as far as the S&P and the Dow are concerned. I think you're going to see it across the board as far as even cryptos. That's my opinion. But I think we have an overextension of what we perceive to be value, and the fundamental margin to reality of where we're at is a big discrepancy. I think inflation hurts the middle class, hurts the lower class tremendously. And the ability to pay is going to be difficult, and it only extends more. Higher prices, higher food prices, higher milk, higher gas is not relative to higher rents. It is just not. I think stagflation is showing its ugly head right now. But with that being said, if I can lead to charts, if we go to page 4 or 7, we had 4 predictions that we've done on the interest rates in the last, I'm going to say 3 or 4 years. So in 2018, we predicted on the lower bottom of that chart that our rates were going to go down. And everyone, including Jamie Dimon, said they were going to go up. In 18, in 19, October of 19 at the seminar, we again said that rates would go down again. This is prior to COVID. But the excuse of the Treasury bump to 0.70 on 10-year Treasuries was due to COVID. Now, in your question, how can this market move up? Well, we had interest rates, the lowest we've seen ever. Okay, we had interest rates on single family in the 2s. That's never been done. So the affordability index obviously has to move. Okay, I say without that interest rate component, prices would have never moved. Absolutely not. I don't see the CPI. I don't see anything in our economy to progress that kind of influx. Is there a correction? It's all mechanical. So at this point, going to our next chart, we predicted at our last webinar in October that treasuries were going to go up. And we were at 70 bips in treasuries last time. We hit a high of 177, and now we're correcting. The interesting part of that chart, if you see one of my middle arrows, we're corrected right at the point where I think we're correcting. Now the question is this correction long-term or short-term? We have to remember one thing. Interest rates are a 34-year low trend. That's a difficult trend to break. That's 34 years of lower rates, lower rates, lower rates. Do lower rates make everything else price up? That's an absolute yes, 100%. Properties, stock market, everything reflects on lower rates. So this correction that we're going to be seeing in the stock market, I believe, is going to cause a lot of volatility. Our VIX is going to go up, and we're going to see interest rates pop lower, maybe short term. Now the question is, what is the remedy to this correction? If it's more dollars to inflate out of this correction, then we're headed back to the stagnation trend that we've seen for the last 12 months.
Spear, your thoughts on market timing here?
I'm not a big believer in market timing. I'm a big believer in there's really no wrong time to own real estate. There's no wrong time to buy real estate. There are wrong ways to buy real estate. If you buy real estate on high enough loan-to-value ratio that you're in risk of not being able to pay the payments, you should worry about deflation or drop 20%. But the long-term trend, the arc of history bends toward higher prices constantly, constantly. There are ups and downs, but if you draw a through line from any period of time through 10 years later, prices are higher. Take the Great Depression in 1929, take it to 1939, take the crash of 2008 to 2018, 10 years, it's higher. So in terms of short term, if I'm thinking of exiting for some reason and I'm ready to pay taxes and lose the investment, I could speculate by selling something to get out of the market. But what am I going to do with the money after I pay all the taxes and have so much less and don't have whatever cash flow I was having? So no, short term, I don't look at market timing, I don't look at, so when I look at is this a bubble, the answer is exactly what Gil said. It's a matter of the perception and the perspective, but it doesn't affect my decision making, because what I want to do is continue to buy properties and collect them, make them run right, make them produce income for us and for our investors. That's what I'm going to do, and if the price fluctuates up or down, it's no different than my wife's wedding ring. If it goes up in value, I'm not thrilled. I'm not going to sell it. If it goes down in value, I'm not going to sell it. I don't care. And it's the same thing with these properties. As long as you keep them occupied and run properly, I don't think anybody's going to be sorry they own real estate.
If I can clear up one mention that I said. I mentioned equities and commodities. I mean equities per se, but if interest rates go down because we have a correction, real estate is still solvent. So real estate moves when interest rates go up.
What do you mean by that?
Well, let's say we have a 20% correction in the marketplace right now because of volatility, because of just overreach. You're going to get fear in the marketplace. Typically, in that position, people buy treasuries. People move their capital from stocks to treasuries. Treasuries improve, hence a real estate position improves.
Okay.
I think you're 100% right about that.
Okay. Interest rates going up, you think that would affect real estate prices?
Of course.
100%.
100%.
Yeah. The only way it cannot.
Because doesn't it tie back to the affordability index? Isn't that the idea? Is rates right now?
Well, it's just interesting because it's countered by inflation. So that's why I love charts. Every decision I make, I go, okay, forget what I assume I know, because what you just said makes absolute sense. And from 74 to 1980, interest rates doubled, and California real estate prices tripled when interest rates doubled. Well, how in the world does that work? You had inflation. Okay, so there was a counter. It was your wages went up, and your materials went up, and your values went up. So, but yet you can have the opposite. You can have interest rates in 2009 be going down from 6 to 4, from 17 all the way in 1980 to 4, and we had to bribe somebody to buy something with an $8,000 tax rebate when the price was 50% of what it was 3 years before. So what's interesting about, now, we interviewed Doug Duncan on the Chief Economist of Fannie Mae, and I've learned a lot from some of the stuff that they produce. And they did they always do a 3-year projection on GDP. So in 2020, their projection for 2021 was 2%. In January of 21, their projection for 2021 was 6.5. And I wasn't ready for that. And so I looked up when's the last time we had 6.5. It was 1983. At the same time, they also projected the interest rate for the Fed fund rate at 0.25%. And the interest rate for the Fed fund in 1983 was 10. So what are we doing with a 6.5% GDP growth with a 0.25% Fed fund rate? It's because it's being created. In my opinion, it's not real. If it was real, wow, we'd be off to the races
So
with stopping it with interest rate hikes.
So if it's not real, Bruce, what's next? What happens as a consequence?
You know, this is the problem. It's all policy driven, to be honest with you. You know, that's what's scary. And what you said, you know, and that's why I love being here. You're smarter than I am about what happened in the 70s and 80s, because I wasn't even an adult. I got the beneficiary. I got the benefit because I owned a house that went up like crazy, but I didn't know the mechanics of how that worked. That is an astonishing thing, that interest rates could double and your price could triple. That's a wow. But so I don't know if that's what's coming, or, you know. But I'm trying to figure this out for myself. But it seems like if you have GDP growth at 6.5 that was real, you'd be concerned about inflation and that you'd raise rates to put a ceiling on it. And if they do that,
So there are only a couple of scenarios. You have inflation or you don't, and then in response to that, interest rates are raised or they aren't.
right.
And if interest rates go up, it's going to necessarily tamp down inflation. It's going to necessarily suppress real estate prices. There's no question about that.
Well, there's times that it doesn't, though.
There are times that it doesn't look like it, but when the interest rates went way up and the prices in California went way up, they would have gone up way higher if interest rates hadn't been that high. They would have gone even higher. And so I don't think it's this, that the interest rates went up, but mysteriously prices went up. I think interest rates went up, so prices went up less than they would have.
Well, I think it went up because inflation went up. So one of the things that I was able to study, Cal Poly Pomona has these reports, and I'm literally the favorite chosen one that gets to go in their vault. There's some months or quarters they have only one copy, and no one gets to open those things up, but I got to. And for the 70s and 80s, they actually broke down the cost of a house per contract bid and material for the whole, 15 years.
Talking about construction costs.
Yeah, the actual construction cost. And that's when it dawned on me, oh my God, when I own a rental, I own a basket of commodities. So when you have interest rates up to fight inflation, it was fighting the cost of lumber going up 300%, but you already owned one. You're going, dang, that's good.
It creates a barrier to entry.
It creates a barrier to entry, but it creates a great time if, in fact, inflation takes your house up. If you're new, there's always a correlation, again, between new and existing. And you just crossed existing going more expensive than new. But when that lumber costs the contractor more to build a new one and you own a rental in the area, you just got bonused. Crazy enough.
Yes, which suggests that no matter how high the interest rates go, the prices won't fall horribly because, again, supply and demand.
Well, supply and demand, what happened in 2009. So this is fun. I mean, I'm not trying to be argumentative.
No, it's good.
So in 2009, we actually had migration coming into California. Now you had an absence of demand because they couldn't qualify, but prices were half. So, affordability has a big thing. Now, I'm not saying apartments. I'm not an expert in that at all. But in single family, we have a barrier that when we hit 17% affordability, usually if you're in an honest lending environment, it stops. People want it, but they can't get it.
There's no question. Single family is a consumption item. People look at it as an investment, but in reality, when you own your house, it's a consumption item. Sure, it'll move with inflation, and it's certainly better than renting, but it's not an investment per se. So that's going to be different. Gil, you had a thought.
Well, I guess, Bruce, my question to you is, if rates were at 4%, where they were before this pandemic, before we had treasuries, shoot down to 70 bips, excuse me, do you think we would have had that surge in real estate sales?
I don't think it had anything to do with the interest rate. It had to do with urgency. But I'll answer your question without that. 4% interest rate would have done nothing to damage the affordability to 17%. So typically when you're on a run, you gain momentum. The affordability goes down because people are going, wow, I own a house and it went up. And you just have a natural ending point over and over again, 80, 89, 05, and we're approaching it, somewhere in the next year probably. And the reason it ends is if you're in an honest lending environment, everybody wants it, but the lender has to go, you don't qualify. In 2007, we got to 11% affordability, and I'm looking at that going, okay, well, maybe my thesis is completely wrong. So we interviewed a lender in front of hundreds of people, and I thought I was going to ask a lot of questions. I only got one because I got the answer. I said, a stated income loan. I said, where does the stated income number come from? And without batting an eye, in front of hundreds of people, she said, oh, we just make it up.
Sure.
Yep.
And when I heard that, it was like a pause, and I went, okay, I get it. Uh-oh, we're in trouble.
Right, no, that's exactly what The Big Short was about and how you did that. Remember, though, that unaffordability of single-family residences makes the apartment business stronger, and it raises rents, because the main competition, when people leave our apartment units, some leave to leave town, some leave because they're moving in with someone, or they're getting married, or they're getting divorced. The majority of them in good times are leaving because they're buying a house. And if houses are unaffordable, then the result is that rents go up because the demand on apartments is higher. More people want to rent apartments. So the affordability indexes have very little connection to the apartment business, very little connection. And that comes back to, even if interest rates go up, and it will drive down the price of real estate or suppress its rise, as from your perspective, Bruce, but if it would drive down the price of real estate, does that really make that much difference, so long as the jobs are there to support the people who are paying the rent to live in the apartments?
100%. What I want to see a chart on, Bruce, if you can get this, is the participation rate and population of the working people. How many were participating in this growth of inflation? Because I venture to say, with AI and with technology, what we're doing is we're going to have a lower number of participation, and that has a new chart. So that's really where this lies at. What participation rate is achieving a pass with GDP? Are they growing? Is it only 20%? I don't know. But I venture to say there's more rich people now than ever before, and more poor people now than ever before.
You bet.
So our participation rate is nowhere near what it was in the 70s. And if I recall the 70s, rates went up, properties went up indeed. But I remember my parents buying, and it was on a wraparound trust deed. So they took over an existing 6%.
Yeah.
So they didn't pay 18.
No.
So the real question is, who paid 18?
Well, not even half of the buyers. So I do know that chart. So you had something called a simple assumption. We've had a chance to go to Washington, D.C. and speak in front of Fannie Mae and FHA on occasion. And when it was 2009, I said, why don't you just make them simple assumptions? All of Texas, you wouldn't have a foreclosure because the rents were more than the payment. Just let the loan go to the next person. This was Raphael Bostic. He was in charge of it. He said, I have no problem with that. I said, can you put that in writing for me? And he laughed. He says, no, the public wouldn't buy the policy. So, that's part of the problem, is that what makes sense sometimes they can't implement. I'm going to mention one other thing that residential real estate is going to have a problem with in California eventually. So if we have a price increase that gets us to 17% affordability with a 40-year low interest rate, we have the opposite of what we had since 1980. We got to 17% affordability at 17.5%. I refied my house at 17.5%, and ever since then, with occasional bumps, it gone all the way down to 3%. Well, that's replenished affordability and allowed per price run. If you start at 17 at 3%, how's that going to inflate?
You mean as interest rates go up?
Well, yeah, if you have a 3% interest rate and a 17% affordability, the next 40 years will be the opposite of 80 to 20.
As single-family houses go, that's right.
Yeah, that's going to be an issue. You're not going to have affordability built back in.
And that'll help drive up apartment rents.
It'll definitely drive two things. It'll drive apartments and it'll drive exits for people to go, I can't afford here, I'm going to buy somewhere else.
So what do you
no.
make of this? If you're listening to this and you own apartment buildings, the answer is go buy more. That makes me want to run out and buy an apartment building. This is, as from an investment perspective, this is what it is. And I know some people who will see this are not part of Chris German's excellent apartment owning audience. Some of them are not apartment owners. Figure out a way to buy an apartment. This is the way to do it. This is, we live in a country where total strangers will buy real estate for you, and those strangers are called tenants. And if that sounds unfair to you as a tenant, figure out a way to get a better job, clean up your credit, buy a property, see if you can buy a duplex instead of a house. When you aspire to buy something, don't aspire to get out of your rental unit and buy a house. Try to buy a duplex or a triplex, or put together money with 2 or 3 people and buy a 4 or a 10 unit building. Buy an apartment. It's a good idea.
Well,
No.
in fact, I want to mention, Chris, and Gil, you mentioned something that was important. It was on the governmental interventions with interest rates. Bruce, one item that we need to remind each other, and this is going to affect every landlord out there in a good way, all your tenants that have children, effective in July, when we were talking about artificial intelligence and technology replacing workers, the universal basic income strategy is coming to America effective this coming July. The IRS is going to start mailing out checks to every family for, depending upon their income limitation, where they're going to get a monthly advance of $300 per child that you have that are 5 years of age and younger. And if your child is between ages 6 and 17, they're going to get a $250 check monthly in the mail from the IRS. And that starts in July. That's part of the government's universal basic income strategy to forecast job displacement for what we were talking about earlier with technology. So here's another example of another government stimulus that has not been talked about because those checks have not been sent. So your tenants should start seeing this additional cash flow in the month of July. And
How long-
that will be go ahead, Chris.
Sorry, so they start in July and the checks continue until when?
Until they turn 17 years of age.
I had not heard anything about this.
Neither had
Yeah.
I.
Yeah.
Gee, what a great idea. That's just going to work wonders.
Is that national, the same number, is that same dollar amount for Florida as California?
It's national. It's not indexed to a state's affordability level. It's national. So as you can imagine, this is going to increase inflation even further because
Wow.
they're going to spend money. And it's found money for a lot of these families.
So here,
And
That changes everything.
go ahead, Steve.
what we were talking about earlier about how to forecast trends and predictions, the first thing I said today is I have no idea what's going to happen because of governmental intervention. Because now we're going to have another influx of cash going into the economy that none of us have experienced before, where these mothers are going to get additional cash flow, with mothers and fathers, for having children that are under the age of 17. And that's going to be a big boon to support what you're saying, Stephen Superior, that it is a great time to be a landlord if you buy in the right places, because there are going to be additional sources of cash flow for these tenants to pay their rent.
And so to be clear, Steve, this is approved. The checks are going in the mail and no votes needed, no further votes needed?
That's correct. It's part of the American Rescue Plan that was signed off due to COVID, and will provide families with up to $3,600 per child.
Are you talking about the one that was signed by President Biden or the one that was signed by President Trump in 2020?
The new one by President Biden.
And so some folks think that the reason they can't find employees right now is because people are making more money staying at home. Steve, what do you think the effect of this will be on people's ambition to work?
And we're gonna have an issue that Europe's experienced for the last 2 decades. And Bruce, when you were talking earlier about your trends of affordability to interest rate policy, I'm thinking we have to look at Europe as use cases of what happened in England and in France when they created these social programs that incentivize folks to stay in the university to earn 3 master's degrees versus working. I think we're going to see trends of that here in America because of these social programs that are that are incentivizing folks to stay at home.
Now, I like to keep things simple, and I know for some of our audience watching today, they maybe didn't follow the full conversation about interest rates and so forth. And one of my clients, who is, if not the largest, one of the largest multifamily owners here in California. Matter of fact, if you would have done a search last year, in 2019 for transactions in California, who were the buyers? It was my client, number one on this chart in terms of multifamily. And he's gotten as successful as he has by being simple. So I want to look at just a few simple things. If I would have told you gentlemen on March 19th, and we were all together March 19th of 2020, this was the day before the stay-at-home order. If I would have told you that we're going to come out of COVID financially in better shape than we are entering into COVID, the stock market's going to be better, real estate's going to be better off, you would have said, Chris, you're crazy, right? And so how much of this is just the economy running on a high because there's so much money that's been pumped in, and you can see the stupidity, and why do I call it stupidity? My client was at Mercedes looking at a SL600 or something. They said, if you don't come quick, we're going to sell the vehicle because people are overbidding on the car right now. He gets there. They had held the car for him because he's a good customer. There was 3 people waiting to bid on the car. There was a G-Wagon in the showroom, he tells me, that ended up selling, and G-Wagons are not cheap, ended up selling for $50,000 over the sticker price of the vehicle. This is what's happening. So when you hear about things, the stock market, how much of the inflation is due to the fact that people were at home getting checks from the government, bored as could be, so they thought, hey, great, I'm going to go watch Reddit or look at Reddit. They're going to tell me what to buy in the stock market, and all this money got pushed into the stock market, and that's because we have a lot of the inflation there. I just think that with the question with the bubble, you look at some of these things, a lot of it does not make sense, and I don't know that it's sustainable. And so, to me, if the apartment market was a baseball game, okay, baseball games are 9 innings. This market has been going up since 2010. If multifamily was an apartment building, I would venture to say we're in the 13th inning. I just can't tell you, is it going to be a 14-inning game or a 15-inning game? All I know is a lot of this stuff does not make sense. And when tenants are spending 55% or more of their discretionary income on rent, at what point do you does the straw break the camel's back? And I just don't see cap rates being compressed, and so I think it's somewhat of a bubble.
So you think it's a bubble, and when it breaks, do you see a drop in prices to some extent, or do you see a crash?
So I want to take caution here because what else is a broker to say except, hey, sell, right? It's always a good time to sell. What I'm saying is you have to be cautious to think that, number one, this was supposed to happen, and number two, it's going to go on forever. I think that's what I'm saying. And so, when we teach our clients, we try to take this idea of investing in multifamily, make it real simple. You guys are familiar, I talk about the 3 pillars of the financial legacy. Maximizing what you own. Once you've maximized what you own, growing from there, and then preparing for tomorrow. It really depends on what pillar are you in. In other words, if prior to COVID, in your heart of hearts, you knew you were going to sell, you were okay paying the taxes, you just wanted to write off in the sunset, you didn't want to deal with phone calls or any of the other, I think you really take a close look at it now. Especially, we haven't even had the conversation about the fact that they're contemplating doubling capital gains. So today you could sell and pay half the gains you may pay from a year from now. For those that are saying, well, I'm holding because I don't want to pay those gains, I'm going to give it to the kids, it'll be for theirs to decide, well, what if they did away with step-up basis? Would you do anything different if you knew your children were going to pay the same amount of capital gains that you would pay if you were to sell yourself?
Will they pay the capital gain, or will they simply inherit the property at your basis?
Well, right.
Because otherwise they would force the sale of every property when anyone died. And I don't think the government even wants to do that. If they eliminate step-up in basis, then children will inherit the parents' property, keep the low basis, and if they sell, they'll pay it. But then they won't pay any estate tax on it either.
I think they're trying to figure out how to pay for $4 trillion worth of, and now this new money that Hall just mentioned, they got to figure out how do you foot the
And the only place to pay for that bill, the only way any country in history has ever survived that type of debt that we're getting in now is inflation. And I think this is why you are hearing the people who are the proponents of the 2 trillion, the 2 trillion, and the 2 trillion, that they are saying, well, go ahead and pay your people more if you can't get them to show up for work because of all the money we're sending them. You're just not paying them enough, pay them more. And the implicit suggestion is, and go ahead and raise your prices. Because if you have inflation, and I don't mean runaway inflation, if you just have inflation that runs at 5 or 6%, and that's going to solve a lot of the problems the government is going to have otherwise. And if they let that run for a little while without severely raising interest rates, then the government debt essentially gets paid down, or at least, or in effect minimized by inflation, because you're paying back with inflated dollars. So, and I think they might very well turn capital gains from 20% to 40%, 39.6 or whatever. But then they're going to not see very much income. The government won't see very much income because people will hold properties. And if you eliminate exchanges and eliminate bump up in basis, you might see properties being held for decades and decades that otherwise would have been churned.
Right.
So let me ask this question. I think this is one of the questions, and we'll just take a quick vote here. Do you believe that one of the three is going to get passed in the next year or two? They're either going to alter the 1031 exchange rule, eliminate step up in basis, or increase capital gains tax. And we'll just roundtable it. Do you believe you're going to see at least one of the three? Mr. Hall, you're the accountant in the room. Are we going to see one of the three in the next 2 years?
And again, one of the three are capital gains,
1031 exchange, altered or eliminated, and
bump up in basis.
Bump up in basis.
Okay.
So first off, 1031 exchanges. I think the 1031 exchange lobby, as well as the association, all the realtor associations in America, are strong enough to keep 1031 exchanges alive. That's my personal opinion, because we've been through this turf battle before, and 1031 has always prevailed since the beginning of time for Code Section 1031 when it was written in the code way back when. So I don't see 1031s going away. Eliminating step up in basis, I definitely see remnants of conversations under the Biden administration where they're talking about potentially eliminating step up in basis or lowering the estate tax ceiling to pay for this newfound money that they're trying to fund their way through. And last but not least, increasing capital gains. We have seen the last 20 years capital gains go up and down and up. We go through these roller coaster rides. Do we see capital gains rising? I say yes, it can rise. But if with proper tax planning, you could offset against the increased property capital gain, increase in capital gains with tax structures to offset against the increase in tax from the capital gains. And one more item to add, in the 70s, the individual tax rates were as high as 60 to 70%. However, if you bought real estate or if you invested in expanding your business, they had an unlimited deduction for you to offset against the investment, against your earnings. They're going to have to create some kind of incentive for investment. And that's the key, because if you disincentivize investors to invest, you're going to shut down the economy. And that's congressional members smart enough to know that, because if you listen to any congressional member, whether they're Republican, Democrat, Independent, doesn't matter, they always talk about creating jobs. So they know they have to create jobs. So they're going to have to create some kind of incentive for investors to keep them motivated to reinvest into the economy to create jobs. So if they do increase in capital gains, they will have some kind of offset against the increase in capital gains to redeploy that capital to increase the economy or jobs. So it's early days to see specifics of what they're going to propose, and we should know more in September, October timeframe when Congress is back in session to discuss details of what they want to do.
Gil, what are your thoughts? Given the state of things, what do you think the likelihood is, one of the three or two of the three?
I mean, I agree with Steve. Logic prevails. Everything stays intact. Logic and math. Trends don't follow logic and math. trends seem to be illogical at times, and there seems to be overcorrections and undercorrections. And I think the trend socially is free money. And what Steve just mentioned is a game changer completely to me, as far as the that program that's coming. And I think that reflects back to you, Steve, and being correct completely with inflation. Because now we have a participation rate. Hence, the job market is not creating that.
Exactly.
So GDP isn't.
No.
Now the government is literally paying into this inflationary rate. So I agree with you 100%. Now the real question is, and I'm going to pose this to Bruce. Bruce, what was our deficit at the time of that tremendous inflation
As a percentage of GDP.
as a percentage of
Yeah,
GDP?
probably a quarter of what it is now.
Yeah.
Okay, great.
Yeah.
Great. So there's a quick question. This is really a balancing act. Can our economy sustain this deficit, which has a debt service,
Yeah.
low interest rates,
Well, the answer.
and still grow?
The answer,
Inflationary.
the short answer is no, and the slightly longer answer is, oh my goodness, no. It's
Okay.
not possible.
So okay, I hate to get this. I went to dinner with Doug Duncan maybe a month ago.
And again, for the audience, Doug Duncan.
Doug Duncan is the chief economist of Fannie Mae, been very gracious to get me to Washington, D.C. and talk to people that didn't want to hear from me for quite a while. But it had to do with investor financing. Well, now I just lost the train. Oh, the reserve currency status. There's a Ray Dalio that's a really smart guy. So my chart knowledge is really solid for 50 years. His is for 500. And he looks at reserve currencies and when there's a pattern of when they lose that. And he just come out with a book. He's done it a chapter at a time. It's probably going to be 1,500 pages long in its entirety. I want to read that. But what you're saying is this unsustainable? It could be. And there might be a price to be paid for that. I'm just curious, on the questions about tax, the one that's missing is the wealth tax. Do you think that's not in the cards at all?
You mean a significant tax increase for people making more than $400,000 a year?
The one
No,
floated by Newsom.
you're worth $1 trillion paid.
On your net worth.
Yeah.
Well, as a practical matter, how do you do that? If someone has a net worth of $50 million,
You
say
become an appraiser.
$100 million, and they need to pay 2%, as Elizabeth Warren says, just, 2 cents. So $2 million, people who have a net worth of $100 million don't typically have $2 million in cash because they're fully invested. So they're going to have to sell assets to do that. And if they liquidate assets to do that, they're going to pay tax, capital gains at whatever rate that is on that. So they're going to end up paying probably $3 million or $4 million to pay the $2 million, and they won't have that asset. And that's going to create sales, and that's going to create that's going to create something more of a buyer's market, which will have a downward pressure on prices. And so you have a cascade effect if that occurs.
Yeah.
And so once again, what will happen is the rich will get richer and the poor will get poorer that way. It's not a good idea, and I think that most of the politicians understand that when they stop and think through what I just said. So I don't think that happens.
Do you think that happens statewide in California? Because they're trying to think about, let's just do it for the state.
No, because I think they recognize it will be a net revenue loser.
Right.
Because they will increase the exfiltration of wealthy people from the state.
Absolutely.
It'll be a money loser for the state, and I think they understand that. They already see with some terror the fact that they are losing wealthy people on a constant basis, and as a consequence, they are trying harder. They're trying harder to delay and roll out more slowly things like this in the hope they can slow the outflow. That would substantially increase the outflow.
But if you're going to raise taxes, 40% of taxes in California paid by 0.5% of the household. So you got a room full of 200 people, one guy goes to the restroom, that's the guy that pays 40% of the tab. So if you're going to raise taxes, you got to raise it on him, right?
Yes, and at the same time, when you raise taxes on the wealthy and on companies, when you increase corporate income tax, that gets passed through to the consumer. So it isn't true that no one making less than $400,000 will pay more. Everyone will pay more. At everything from the gas pump to McDonald's, everyone will pay more for a shirt and for a pair of shoes and for a cheeseburger and for anything else they buy. And that will be felt at the consumer level, which will again lead to recession. Let me comment on Chris's question about the bump up in basis and the 1031 and the capital gains. This is pure politics. It's pure politics. You have an election coming up in November of 2022. You have people who are animated on the right about the spending on the left. When President Biden got the first spending bill, the first $2 trillion through, he got it through with purely Democratic votes and did it on reconciliation. These are budget matters, so they could also go through reconciliation. But this Congress is deeply unstable. They don't have a solid majority on the Democratic side in the House. If you don't have Kristen Sinema and Joe Manchin on board, you don't have the 50 votes plus Kamala Harris, so you can't do it. So if you're going to try to do this, you have to do it very quickly, because the closer you get to the 22 election, the less likely it is it will work. With the president's proposal for the second $2 trillion and now for the third $2 trillion, the chances that they can then, on the heels of that, wipe out the bump up in basis or the estate tax or the 1031 or the capital gains tax, the notion they can do all of that, I believe it will be politically impossible. And so my feeling is none of the three will happen between now and 22. And if Republicans take control of either one or both houses of Congress in 22, you won't see any of the rest of that agenda get carried forward.
But that assumes we have a fair fight in 22, right?
I was going to say that.
I think I've said too much already. Mike, your thoughts? I know you're not an accountant, but of course, you speak to the various boards. You're a part of these groups, and of course, this has been a lot of the talk, especially the last month or so. What are your thoughts?
The people I speak to are most concerned about a capital gains increase. That's my thoughts. You guys have gone far above my pay grade, and I'm learning so much just sitting here, and the different perspectives are fantastic. They all make sense. I forget who it was that said it, though. I think it was Gil might have said it. This stuff is just, it's hard. They don't always follow logic.
Gil said that, and he's right.
And I agree with that. And Steve, you just said, and I agree with you also, this is pure politics. And the atmosphere right now is the craziest I've ever seen it politically.
Yeah.
So if it's pure politics, and they're not always logical, and there's this momentum that we were talking about a little bit earlier with this civil unrest and the social policies that they're implementing, we appear to be going down the path of social policies which require increased tax bases. Mm-hmm. And that seems to be what all of the people that I talk to about this are concerned about, is the capital gains increase.
Yeah, just to interject, one thing that we've seen inflation, but we've seen it with our real estate prices and our stock prices. So if we've seen tremendous inflation, okay, but it's only been the rich who get to reinvest in these assets, okay, not necessarily GDP. So our core inflation hasn't moved. But what happens now when the public receives this extra money? That is a core inflation that we haven't seen possibly ever. So the question is, the teeter-totter, how do you balance this without getting into a hyperinflation situation?
And you're 100% right, Gil. It's been in real estate and stocks. What happens when it moves to consumer products? And you're already seeing it in gasoline and lumber prices and so forth. It's going to be in everything. Everything will cost more. Won't matter what. Pair of glasses, pair of shoes.
And the question is fundamentally, how long can that continue?
Can that continue? And when wages go up and it's meaningless because the prices went up again, now what?
Final question of the afternoon, and this is for the entire team. Given your field of expertise, What suggestions do you have for real estate investors to end 2021 in a better position, either financially, legally, strategy-wise, than when we first began the year? And we'll have Mr. Norris start us off.
Oh, my God. Okay. I don't know how to answer that question. I've made personal decisions to go to another state because I wanted my state where I own property to favor ownership over occupancy. So, and that's why I made those decisions. So I guess I would just try to land on a square where I made sure that I had enough liquidity to deal with any negative that might come up, and that I had a position that could survive just about anything. I would like to be conservative about what's next.
Mr. Hall, what suggestions would you give to investors to end 2021 than when they first started?
I agree with everything you said, Bruce. In fact, since I've been to Tampa, Florida, there's all kinds of opportunities to buy real estate out here. And with what we talked about with inflation, the advice I have for everybody is to buy more assets. Like Steve Spurrier said earlier, Gil talked about a little bit, Chris, you've talked about. It's going to be important to buy more assets. Don't worry about the tax industry as far as what Congress will do, because they change their mind after 4 years when there's a new presidential administration. Policies changes, just like Steve Spurrier, you said earlier that for the past 4 or 5 decades, the history repeats itself, and despite the uncertain times, it always works itself out. And I agree with that. But the key is to take away is if you buy more assets, have low debt ratios, have liquidity to cover yourself if there's a cash flow crunch, you'll survive this period of uncertainty.
Mr. Figueroa?
Nothing's changed. History always repeats itself, and I think in times of trouble, millionaires become billionaires. And the only way they do that is buy more of a product that worked. We're making more humans. Humans have to live somewhere. If universal pay is going to garner the difference between that and inflation, then you'll have rents go up and properties do well. And if that doesn't happen, then interest rates will go down and you'll still do well. So in a perfect position, cash out, have the leverage, buy more. If inflation does hit us, he who has the most debt wins the most. That debt gets paid off with cheaper dollars.
Mr. Brennan, your thoughts?
Well, just so I don't repeat everybody else, first of all, I think everything that's been said so far are excellent suggestions. But I will use my own experience to answer the question. You know, during COVID, in addition to all the other insanity that was going through my office, I took the opportunity to take a step back, revisit my business, look for ways that we can improve it when COVID disappeared. For example, you know, we took a lot of technology upgrades. We went into the cloud. It's been a little bit of a bumpy ride. But the point is, I think landlords should do the same thing right now. I think they should try to project to the best of their ability where we're going, especially after, you know, a presentation like this, talk about what they think the future holds for them, revisit how they're holding things, go talk to their insurance carriers, go talk to their attorneys. Another thing, I'm sure everybody by the time this airs will have known this already, but Governor Newsom has now said that, you know, he wants to make landlords 100% whole for the loss in rent that they incurred during COVID. So revisit the whole thing. Take this opportunity to revisit it, realign your goals, set up the professionals that will help you get there, the attorneys, the accountants, the loan brokers, everybody you need to execute your plan and move forward with it.
Mr. Spear?
There are some simple rules in the world. When I was a teenager, I had a job, and it was in a retail store, and when I went into the back room, I saw a sign on the wall that said, "If we don't take care of our customers, someone else will." And this is the same thing if you serve a meal at a hamburger place and it isn't good, you'll lose a customer. And if you're a doctor and you keep your patients waiting too long, you'll lose a patient. And if you're an apartment owner and you don't maintain the property well, you're going to have trouble. You might lose a tenant, you might get less rent, you might get sued, you might have a rent strike, you will certainly have resentment. The way I would finish 2021 better than we left it is in the recovery from COVID, invest money, hearkening on something we discussed earlier, invest money in the apartments. You'll be able to charge more rent for it in some cases. You'll maintain and protect your asset, at least in other cases. Be a good landlord. Do the right thing. Treat your tenants not as subordinates, not as children, not as the enemy, but as customers. They are your customers. And what we have discovered in our law practice is that the landlords who treat their tenants as customers have fewer lawsuits. They just have fewer problems. It's not a solution to everything, but there are fewer problems, fewer lawsuits, fewer claims, less hostility. There is an esprit de corps, especially in the larger apartment complexes, where people just don't want to move because they don't want to leave their community. The resident manager seems like a mayor of a small town. If you treat your apartment ownership as a business and you treat your tenants as customers, everything will be better.
You know, I've been involved now in more than 300 now, transactions, multifamily transactions, either representing buyer, seller, or both. And it's always the same story. They own multifamily for one of three reasons, either for cash flow, for appreciation, and for the tax savings. And of course, a lot of the discussion this afternoon has been about the risk involved in owning multifamily. So I would put forth the argument that you should have more of all three. If you're going to invest your time, your energy, your money, and when I say your money, even your equity that's in the property, if you're going to invest all three, you should have a greater return of cash flow, tax savings, and appreciation. That really is the name of the game. Multifamily has the opportunity to make individuals very wealthy, and at the same time, it does not have to be a drain on your time or your energy or some big stress. As I mentioned, you know, my wife and I own multifamily properties ourselves. We've been very active through COVID, continue to be active investors. Of course, I'm a father of 8, so I'm motivated to be out there hustling. But everything we do, or before every move we make, we take an analysis. Before we consider to sell and do a 1031 exchange, whether we consider to sell an asset and cash out, because we've done that as well, it takes an analysis. And so I would say, as you continue forward this year, really take stock of your house. Who does your taxes? Is it Uncle Larry because Uncle Larry's so nice, or do you have a true tax professional? Your debt. Do you think it would be wise to have more cash on hand? Should you consider pulling some liquidity from one of your properties or refinancing current debt to take advantage of the low interest rates? Because as it's been discussed, that could change. Do you need to retake a look at your rental agreements? Seek some legal counsel for tenants that continue always to be a thorn in your side. And now it's time that needs to be addressed. And you're saying to yourself, well, what options do we have given all the regulations? There's 2 attorneys here. Pick one of your choice. The point is, do something. This afternoon is about presenting you information for you then to pivot and take action. I would start with an analysis. Where are the holes? If I were to ask you, even if you think your situation is ideal, what's 1 or 2 things you could change to make your situation more ideal as an investor? I would take a look at that and address it. Gentlemen, I want to thank you for your time. In a live setting, this is where everyone would stand on their feet and give you a roaring ovation. But I know that the viewers are definitely appreciative of your time. It's been very insightful, so thank you again.
I just want to take a moment to say this. Chris, thank you as always for organizing this. And my thanks to Bruce and Mike and Gil and Steve for all of us being here. I got to tell you, it's such a privilege to be with this distinguished group of professionals. You guys all know exactly what you're doing. And when I think about the apartment dealer, Chris German, and the fact that he brings this together, provides the education, all of the content on his website, and all of the things that he does to help people buy and sell and own and exercise leadership in their lives through owning apartment properties. It is America at its best. Chris, thank you.
Thank you. And to you, the landlords, we wish you well until our next educational event. Be sure to go to our YouTube channel. There's hours of content with these gentlemen that are here with me in previously recorded interviews. And until next time, I wish you positive cash flow, tenants who behave, and much protection from Uncle Sam. Chris German, the apartment dealer. Till next time.